9th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan's still out. He'll be back tomorrow. Mike Butler sitting in live in studio in Chicago, here to take you through the rest of this hour as we wrap up your trading day. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade. If you're on the website, tastylive.com, welcome. Thanks for coming. If you're on YouTube, join the conversation. Tell us what you think of a day where the market shrugs off the tariff headlines. S&P 500 now up by another just over 0.5%, 63.07 here. NASDAQ is among the leaders, up by 0.63%, buttressed by Nvidia's push to a $4 trillion market cap. The Russell, of course, is the top performer today. That's up by 1.03%. We have bond yields coming in at the long end of the curve. Scott Bessent talking about changing issuance. And, of course, we had those Federal Reserve June meeting minutes out. After yesterday's tariff announcement for copper, prices did calm down a little bit. Metals are mixed, if relatively quiet, all things considered. And you do have energy that is relatively staid, except for natural gas, which collapses on the back of another forecast for even greater inventory levels than what we had previously. And finally, in the FX world, the dollar's rally. It loses a little bit of steam here. We are looking at mostly an unchanged day. There were a bunch of interesting corporate headlines out. Linda Yaccarino stepping down from X or Twitter. I don't know if anyone followed what Grok was doing yesterday afternoon. I can't help but think that maybe has something. I was
paying attention to that one.
Might have something to do with it. Mike, before we really dive into that story and Tesla, let's talk about what's going on here in the S&P 500, where we have IVR below 10 now. Same thing for the NASDAQ, 8.6 on this chart. We're just pushing higher and floating higher. Dare I say, as a fellow bull, I was a little peeved when I heard you say this market's a joke. So tell me, why is this market a joke?
I mean, technically it's not. It's a real market. It's just
oh, good.
Yeah, in case you didn't know, it is real. It is tradable, but I mean, it's crazy. Like the rally from the lows, it's like a meme stock. Like SPX looks like a meme stock. But yeah, it's surprising to see the tariff headlines shrugged. Although, is it one of those cases where we already got the fear with them and now it's more of just okay, what are they? But it doesn't surprise me considering the level of the VIX we're at. I mean, when we get to the mid-teen, low-teen levels, if you isolate that in an SPY chart, it's up and to the right. There's still chop, of course, but yeah, I mean, if we stay in this level, if volatility clusters at these low levels, which is what we've shown with research, that tends to happen. When you see volatility in low periods, it tends to stay low for longer periods of time. I don't know. I wish there was more volatility in the markets, but luckily earnings are just around the corner in a lot of these big name tech stocks, so maybe we can create some there.
Oh yeah, volatility is at a cycle low. We have these tariff news, headlines, data points, tweets coming out seemingly every few hours at this point, and yet all priced in. It was always all priced in, right, Ilya?
I mean, I don't think it was always all priced in, but I think now that we've sort of done the seesaw in the first half of the year, now the baseline seems to have been absorbed by markets. I think the markets came into this year, and we've talked about this at length, with the idea that the tariffs themselves were not going to be a scary thing conceptually because they'd been seen in the first Trump administration and wouldn't go anywhere different. Markets started to freak out when they did appear to be different, and business and consumer confidence appeared to not like it. Then we kind of had a crescendo in April, and ultimately the administration stepped back from those things that the markets were afraid of, and now we see that there's been a sentiment shift. So from April until right around now, right around the start of the second half of the year, we basically reset equity sentiment to say, no, hold on. It sounds different, but it actually is just about the same thing. There is more bark here than there was last time, but maybe and perhaps there is not more bite. And the thing is, we still don't know because there aren't really any deals on the table, but we do appear to be constantly getting a kind of what I've been describing as the guy at the bar that screams he wants to fight and yells at his friends to hold him back, and they're not doing anything. It's the kind of thing where even Peter Navarro came out today and was saying, well, obviously these letters to all these countries are a negotiating tactic. Peter Navarro of he's never met a tariff he doesn't like fame.
Ron Vara fame, yeah.
And was arguing strenuously for years that tariffs are a good unto themselves, not as a negotiating tactic. So this is, I think, from a sentiment perspective now, being written off, where the markets are basically saying, yeah, okay, fire, fury, bark, bark, bark. But what does it all mean? Well, we had a deadline today, ostensibly, but now it's August 1st. And then China in 2 weeks. And I don't think the market is any which way confused that if you got to a deadline and there wasn't a deal, there'd be a new deadline.
Well, the NASDAQ technically closes at a new all-time high today with this. Mike, before we move away from the volatility conversation here, could I get your opinion on what's going on with the term structure right now? It feels like the floor has absolutely fallen out in the spread between the front month and the back month, where a few weeks ago it was hovering like 5, 6, maybe coming back into 3 or 4. Now that's blown out to like 9 points. Is this the story right now, that front month volatility, until the big boogeyman comes home, we're just going to continue to fade this? It's going to continue to get sucked out of the market. And as such, a 16.49 vol for August, who's to say it can't fall lower?
Yeah, I mean, from what I remember, when we moved out of backwardation in COVID, and we went back into contango, I think the steepest I saw was like a 2-point or 3-point contango. And we are at 1.25 right now ish between Q and U. And then it does flatten out from UV to X and Z. But yeah, I mean, the lower the VIX gets, the steeper this is going to get. And, it feels like there has to be some kind of catalyst going forward that would bring us back into the 30, 40, 50 VIX range. Otherwise, I think we stay sub 20. Maybe we hover between 15 and 20 and see some chop. But it feels like we're back in the what's the catalyst narrative.
I'm having
such
a hard time.
I would absolutely love it if markets crashed with no catalyst.
Of course you would.
But as opposed to with a catalyst.
Yeah.
Because with no catalyst usually means that something really wrong is afoot. And you might really get a sell-off.
Yeah, if there's a catalyst, then there's an ointment. And once the ointment's applied, you go back to where you were.
Yeah.
But I find this volatility situation really interesting because it's, markets obviously seeing through Trump's tariffs, but where does Trump always chicken out come from? We don't say those words around here. They come from the fact that Trump backed off once the markets freaked out. You don't have the taco trade without the markets freaking out first. You don't have me giving our ode to the bond vigilantes in early April, Ilya, saying how they saved the economy, which they did, unless the market freaks out first. So there's no taco trade right now. It can't happen because the market isn't freaking out. Trump sees no reason to not push ahead with these things because the market's not freaking out. It's only once the market freaks out does he rein back his actions. And so what did the market tell us today? It's the bonds that get spooky, right? Those are the things that he cares about most. That's what he was tweeting about back in April. We had a 10-year note auction today, guys. Great demand. Stop through by 0.3 basis points, bid to cover ratio above the 6-month average. So we just put out this one big, beautiful bill, which looks like a steaming pile of crap, quite frankly. Okay. Bottom 80% of income earners are going to
So you're being
money.
Generous.
Being very, just the math. Bottom 80% of income earners in this country are going to lose money. Okay. So now we're going trade wars. We're financing deficits and debts. Oh gosh, bonds, notes are selling off from 112.5 down to 110.5. You're seeing the same thing in ZB. And then here come the auctions this week. 10s today, 30s tomorrow. 10s could not have gone better given the context.
You and I were talking about this at the beginning of the week, right? And we were saying how interesting it would be if instead of the sell America dynamic in these auctions, what we saw was lots and lots of demand, and whether that might suggest that people want to be locking in these yields because they think that rate cuts are going to be much more expansive than the Fed has owned, because of course Fed funds futures are pointing to exactly that. And at least for the 10s so far, people want to lock in based on the auction results today. People wanted these yields today, and they wanted to lock them in.
So I think that's a good thing, right? We see lower yields. Stocks are able to climb on the back of the fact that there's a little bit less pressure in the market here. Mike, do you have any feelings on TLT, ZN, ZB right now? I can't help but notice the volatilities are really starting to fall out, both the belly and the long end of the curve. TLT has a 6.7 IVR. If you're going over to ZN, it's actually in negative territory at this point in time. When vol's this low, is it just a dead trade to you, or do you get a little bit more creative with perhaps some exposure you'd like to take, if you take any at all?
I think it's interesting to note. I'm looking at the probabilities for rate cuts, and last I checked in December, we just fast forward to where we might arrive in December, it was at between a 2 and 3 25 basis point cut. There was like a 90% chance that we get there. Now it's a 70% chance with a 20% chance that we only get one by December. But our first new shiny, exciting rate cut is projected to be in September. So yeah, I mean, I think you could play it directionally. Like it seems like these have moved a little bit, but if you think that we revert to what they used to look like, I think there's a trade there. And the nice thing about TLT specifically is that, first of all, it's trading at near multi-year lows, and volatility itself in there is so low that you can throw on a zebra back ratio spread and basically get into almost 100 deltas for a very low cost. Like in the 37-day cycle, whether you think TLT is going up or down, it's going to cost you less than $500 to get close to 100 deltas in there. I actually have that position on to the upside. I've got the 85-80 call zebra, for better or worse. But yeah, I think when we're in these periods of low volatility and the market's grinding higher, when nobody's talking about downside risk, to Ilya's point, if it does happen, there's no better time than to throw on some hedges now. When volatility is low, we're at market highs. You can throw on butterflies, downside diagonals in SPY or the Qs if you think we might see a reversal here. And it's not going to cost you as much as if you were to do it after it happens, of course.
Yeah, you mentioned TLT being at a multi-year low. I don't want to say that you were underselling it, but this is a monthly chart. Mm-hmm. If you bought TLT at the end of July 2006, there was a point today where you were underwater in that position.
I know. I got back long. I don't even pretend to Mike's option structures expertise. I did it in the very simple way of just a garden variety call vertical. I mean, this is a single digit IV in here. This is great. 86 to 95. Let's go.
Yeah. And even if you're going out further, like let's say you're throwing on some more leverage, like a leap option in Jan 2027 to Jan 2027 to get back to 95, it's only $300 in risk. And if you get there, that option more than doubles.
That's a really good point. We had the FOMC meeting minutes today. I don't think they told us anything new or exciting, Ilya. They said that a couple of officials thought the next
things there.
Well, they said a couple of officials might be interested in considering a rate cut at the next meeting, but considering in the immediate wake of the June Fed meeting, we heard that Bowman was
We know
out
who
there
these
saying,
are. This is
we know who they
Waller
are.
and this is Bowman.
Yeah, and like
This is the couple. There's the one and there's the other.
And the Fed uses very specific language when it describes things. So like a member versus a couple of members versus a few members, right? Versus some members and many. Like there are literal numbers attached to each of these, and they scale up. Like one, two, couple is 2, a few is 3. Some is 4, many is 5, half is 6, right? Looks like you can just work your way up. So we know we know who they were. They made themselves publicly available immediately after the June Fed meeting, saying that they thought that July could have a cut, which we've all joked is an open audition to be the next Fed chair. Okay, so we have that in the minutes. We also see that structural inflation is going to be a little bit stickier, although I can't help but wonder if the Fed is leaning on a little bit more theory than reality right now, Ilya. And I want to just point to their own Cleveland Fed Now inflation dashboard. The current run rate for July CPI, and granted, it's only July 9th, but this is we're tracking prices in real time here with thousands of data points. July CPI at the headline is tracking at 0.16% month over month, which if you annualize that for everyone sitting at home, 1.0016 to the 12th, you're going to get an inflation rate roughly 1.93% year over year. If you go out to one of the juicier readings, like 0.24%, you're going to get an inflation rate that's closer to 2.94% year over year annualized. But in this range, if you're getting month over month readings in the 0.16 to 0.24, that's going to be wrapped around 2, maybe a little bit above it in some cases, but it's pretty darn close to 2. So where's this inflation scare that the Fed is worried about, that we're all worried about, their one-time price adjustment before things go back to normal and we get more concerned with the growth fallout? Where is it? And if it's not here now, why?
It shouldn't be here now. It shouldn't be here now. This is absolutely normal. And this sort of speaks to the Fed's conundrum here, and arguably why they went down from 2 cuts to 1 cut in the SEP for 2026 when they issued the June update. The idea that you're going to see a tariff pass through to consumers before you know what the tariffs are. Remember, we're in the midst of a 90-day now, 100-day pause after the update, give or take 110,
112 days.
So what tariffs? At this point, we haven't had the tariffs actually take effect to their sort of fullest extent. And this sort of speaks to why when the Fed is writing their statement in June, they say uncertainty has diminished but remains elevated. Well, that's a relative statement. Relative to May, relative to March, when the Fed is saying, is he serious about this foam board stuff? Is he not serious? When is it going to happen? If it does happen, that'd be a shock, but it hasn't happened. He's put it all on hiatus, and in any case, it takes time, because what did we see in first quarter GDP numbers? Historic jumps in imports as people were front-running these tariffs. There is a ton of inventory near term to shield consumers. That was what the first quarter GDP report was all about. Massive surge in capex through inventory building, and massive surge, 40% and change on imports. So the costs are not supposed to be showing up right now. We see in the PPI data that the companies where you do see these tariffs are eating it and taking the hit in margins and not passing it on to consumers. So it's not supposed to show up yet, which from the Fed's perspective is every reason to think that what they're saying and what they're worried about just keeps getting pushed back by all of these delays, which means that they are not going to have certainty about what to do in size in an extrapolated way on rates for a longer and longer time, which is funny because the administration is obviously wanting them to cut and creating every condition for them not to do it.
Mike, if this is a crazy market where nothing makes sense, can I invite you into a rabbit hole of crypto?
I would love it.
Hey now.
Please.
We've been entertaining, a view here, and we put one of the positions in the follow account vis-a-vis IBIT in the long 75, short 85 call spread, 72 days to expiration a few weeks back, because this looks like a fairly textbook. I don't have it near me, but I would literally pull out the page for what a parallel channel or a pennant flag looks like following a breakout. It's bottom left to top right. You have a very clean retest in April of basically the swing levels that you have from March of 2024. And now this triangle, this parallel channel, however you want to have it drawn, today we clock a new all-time closing high here in IBIT, in the futures market. This looks like this thing is getting ready to go. And the measured move of the consolidation gives us a $135,000, $302,000 price target in the short term, which in IBIT terminology would see us go probably towards $76. But look, if we're gonna run up deficits and debts, right? Where do the wealthiest put money? They don't buy more stuff. Can only have so many pairs of blue jeans, so many cars, so many homes, literally. They just start to put it into the market, and you have to get your return somewhere, don't you? So you take a little bit more risk. You don't buy corporate bonds. You buy equity. You don't buy, mega cap tech. You buy small cap tech. You buy value, even if you're feeling really crazy. But eventually you get to crypto because you got to find a return somewhere. This chart looks insane to me. I can't. So, I guess pop my enthusiastic bubble here. Why shouldn't we be using this opportunity to buy even more?
That's a great question. I mean, I am dangerously long crypto, but I mean, it's. I think it's. Well, you do know what next week is. Next week is crypto week. That's not even a lie. If you search crypto week, it is a designated week by the U.S. House of Representatives. But yeah, I think
that was like Shark Week. Like the Discovery Channel comes out and like looks at a bunch of incels in their mother's basement, and like David Attenborough narrates it.
Yeah, I mean, I think there's a lot of positive. I think there's a lot of positive things happening in the crypto space, and it's still really early. Like, I mean, a couple months ago we were talking about how there's a lot of people saying it'll never get to 100K, and now 100K feels like the floor in Bitcoin. And the more capital that goes into it, the more asymmetric the price is going to get, because once all the coins are mined and we are stuck with the finite cap in Bitcoin, like if more capital keeps going into it, of course the price is going to go higher. So, and I do see it as a digital gold type asset. And I think we talk about this every week on Monday on Option Trading Concepts Live with Ryan. Bitcoin dominance in terms of all of the flow of capital going into the crypto space, it hovers around 60%. And I think it'll stay above 50% for the long term. If other capital flows into other places, it's because something has happened that's big. Maybe something was created on Ethereum and it's used everywhere, something like that. But I mean, at the end of the day, if you compare Bitcoin's price history, even over the last couple of years, it outpaces a number of other benchmarks. So I think it's here to stay. I think we'll eventually get to 200K, eventually get to 300K, because it's also another way to put it is like, okay, if inflation is here and if we're going to be at a higher rate of inflation than maybe we want to be at, what does that do to asset prices? It's just going to continue to inflate asset prices, and Bitcoin is one of them. But Bitcoin has a finite supply, so I think you have that upside pressure. And right now, speaking of low volatility, Bitcoin is at levels of volatility we haven't even seen. Like the actual Bitcoin volatility itself is sub 50% if we're looking at the futures. So I think if we get a big move to the upside, we will see an increase in Bitcoin volatility. And that's where you could really see the gates fly open here.
Gates could fly open here soon. Ilya, I know this must disgust you. All of this crypto
Oh no, I just
talk. Can you go ticker agnostic for us here, though? Like,
Sure.
pretend this.
sure,
How does this look?
not great. Not great. And I'll explain why. It's for the same reason that it's looked not great this time last week, the week before, the week before, the week before, because for weeks we haven't gone anywhere. We're still sitting at the highs from late May. We've not broken the
And where are all the
range.
goons? Where are all the goons on their boats in Miami and their rented Lamborghinis driving around bragging about how they've nailed the crypto market? This has been
If
quiet.
ever-
That's great. It's great. No one's
I
celebrating
don't
this.
know if it's been great when you consider that, and we'll take a step back from ticker agnostic for just one.
Yeah, childhood
second.
trauma. What's your problem with all-time highs?
It's very simple. You don't have any movement out of the range that's established a double top for you going back to the beginning of the year, late last year. You're still stuck at the same levels. Maybe you break higher, maybe you don't, but you haven't. That's just on pure technical grounds. But for a second, let's take a step back and say this is a non-yielding, high beta risk appetite type of an asset.
Mhm.
Stocks have been surging. Not this thing. The dollar has been selling off through the period of this congestion. This thing is denominated in dollars. It hasn't rallied. It's still in the same range. This is
Bitcoin's outperforming SPY this year.
I'm just looking at the price action dynamics. Since this thing topped and it's back now to testing the top of the range that we've been looking at, that top, let's call it late May. So for the better part of a month and a half, let's say, we've gone nowhere. We've oscillated in a band. Okay, what has happened over that period of time? Stocks have ripped. The dollar has sold off. These are ingredients for Bitcoin, you would think, to be soaring, and yet it isn't. When an asset doesn't rally in a very positive, under any circumstances for it, type of an environment, that asset is inherently weak.
It did rally, though. It's up 18.77% year to date. It did the rally in April when it outpaced the rest of the market to the highs. I feel like the rest of the market's catching up now. Like, this was a period of time from mid-May onwards.
Maybe,
where, like, instead of
but
allocating incremental dollars to crypto, people started allocating incremental dollars back into stocks, because this is really all post-Geneva, right? The pause in Bitcoin's rally is all post-Geneva, U.S. China meeting in Switzerland. And then that's when the stock market takes off.
I mean, you can have any number of theories as to why it's not continuing to participate, but you can see that the bounce from April lows is the same bounce that stocks have from April lows. It's the post-Liberation Day bounce. You can see that the seesaw here from mid-February to April, then from April back up, mirrors the seesaw in the S&P 500. Only the S&P 500 has now surpassed its highs from the beginning of the year, and Bitcoin is struggling. So, to me, disregard my general skepticism of the space. If you look at an asset that is essentially S&P 500 on steroids type of asset and has generally behaved that way since late last year, same top in late December, same digestion through mid-February, same sell-off into April, same bounce. It's the S&P. Dynamics-wise, only the S&P is at a record high. And this thing hasn't managed to take out its high now for I mean, in a few weeks, it'll be 2 months' time. So far, let's say about 6 weeks. So by any measure, this is an asset underperforming the dynamics of risk sentiment. Why? Who knows? There could be 1,001 reasons. But it is, and that much is clear. So if an asset is going to reveal itself to be inherently weak to its benchmark, well, I don't see anything particularly enthusiastic or positive to think, my long-term skepticism entirely notwithstanding.
We'll leave it to the chat. You think Ilya has a point here, or should he go get his corpus callosum checked? Well, there are gradients in between, but that's where I should scale this. That's where, as someone who's long and
it's pointless. We already know what we're going to see there.
Let's revisit after crypto week. How about that? It's coiling for its 20% moonshot. That's what's happening.
Unless, of course, it's coiling for its 20% sell-off.
But really, actually, one thing I wanted to say that I forgot to mention is, the future of money was always faster and faster and faster, instant. But, right now we have like ACH, like if I withdraw or deposit, it'll be there the next day. That's too slow. So like the solution for instant settlement is a crypto solution on a crypto ledger. So I think that will be the first use case that is broad-based in the world that we know today, where you can have settled cash through a crypto solution to ensure or to get to the instant money transfer that everybody yearns for. Because like right now,
I agree. I just think it'll be a CBDC.
Sure.
Such a shell. Such a
But crypto week next week, everybody.
Has ever given up the power of issuing legal tender?
If you have dollar pegged, I don't think it's going to be the U.S. economy that gives up the taxation.
No, willingly, and not under pain of utter economic ruin.
We're getting some chats. I thought Tim Knight was the resident bear. Ilya's painting a picture of doom and gloom. Ilya needs a puppy or something to bring him joy in life.
I have kids. My hands are full.
Fair.
Today, with yields coming in today, though, today was a good day for things that tend to be rate sensitive. So, tech leads the way up. Semiconductors have a relatively strong performance, although only edging out the NASDAQ by 5 basis points there. I can't help but think, again, kind of like Bitcoin being quiet, Mike. You don't see the parades happening this time around. Where are the fireworks for Nvidia hitting a $4 trillion market cap? And I know they were like the CNBC stories and the headlines were out there today. But it felt like when we were approaching $2 trillion, it was a big deal. When we were approaching $3 trillion, it was like the lead story in financial news. Nvidia is growing so fast. $4 trillion is here, and everyone's like, oh, yeah, kind of expected it.
Yeah.
What does this tell you about sentiment in the stock right now?
I mean, it's a historic moment for sure. But Glenn today out from the TastyFX team had an all-time quote. He said, they say getting to 4 trillion is the hardest. Getting your first 4 trillion is the hardest. Yeah, I mean, I think there's a couple of interesting ones, like Nvidia's going to the moon, Coinbase going to the moon, likely front running potential legislation for crypto. But yeah, I mean, were you like, what? It doesn't surprise me. I don't know what to say. Like when Nvidia dropped below 100, the multiple times that it did, it just like rockets back to 150. So I don't know, man. I think it's just a product of where we're at right now. And I don't know. Is this could this be tied to the bill and the AI legislation in there?
It could. That's such a good line by Glenn, by the way. This may be dating some of the audience, but in 2012, Drake, of all people, tweeted out Drake of all people tweeted out, the first million is the hardest.
Yeah.
And then naturally, oil financier who has since passed back in 2019, but oil financier T. Boone Pickens responded to him, the first billion is a hell of a lot harder. which goes pretty hard. Like, good on you, 90-year-old man dunking on Drake. That's awesome. That's fantastic. Okay, so
that sets off an auspicious sequence of events, only to meet its crescendo at the hands of Kendrick Lamar.
Yeah, I was about to say one of those sliding door moments of life where Drake just
through Pusha T to Kendrick Lamar, and it's not looking good thereafter.
All right, we haven't had a chance to talk about Twitter today, so let's talk about the 800-pound Mecha Hitler in the room. What the hell happened on Twitter yesterday, Mike? Why did Linda Yaccarino step down? Like, I want to believe in these companies. XAI has a very impressive. Can I retract that? I don't think it has an impressive model anymore.
No, it doesn't.
Elon Musk's portfolio of companies between SpaceX, Neuralink, Tesla. I mean, Tesla merging with XAI. We've heard a number of analysts talk about the upside potential. He just can't seem to stop stepping in it, though. What do you do with Tesla here, Mike? It's not like there's a ton of vol on the board.
I mean, the good thing about Tesla is it continues to provide volatility and implied volatility. So selling premium there, if you have an account that you can do so in, has been nice. It's been in this range. I mean, it's super volatile, but you can capture that range and still get paid because we're sitting in a 60% IV, and that reflects a low IV for Tesla with an IV rank of 17. Yeah, I mean, but Tesla's one of those weird stocks where it's like, it doesn't really matter what they say or report for earnings. It's like all sentiment driven and all tweet driven. I actually saw some tweet. It was pretty funny. They were like, I just can't stop myself from shorting Tesla because I just don't see a world where Elon doesn't tweet something ridiculous about this bill over the weekend. And he sure did. And it was down this week, pretty much all week. But
what's your edge in the market? I know that Elon Musk can't help himself.
Literally. But yeah, I mean, they have earnings coming up.
How'd you pay for college, Dad? I shorted Tesla anytime Elon Musk tweeted.
That's a meme for the ages. I'm pretty sure Tesla's the first company that is going to report, like one of the first big ones in the Mag 7 that's going to report July 23rd. I'm trying to see if the other ones are close, but yeah, I mean, 29 point expected move, almost 30 points, almost a 10% move. Even given all this, 10% move for earnings is big. So we'll see. I got to stay defined risk in there though. It's too big of a product for me.
It's very big. That's actually, we were having this conversation earlier in the week, and I was saying, you know what? Even I'm looking at maybe buying Tesla here if you want to be fully ticker agnostic and just look at the chart and go, we're in the middle of a range, we're on support. The risk reward is great here, but ultimately it's too big. It's too big. I can't structure even a vertical that I like here that would keep my loss to within, let's say, 2% of equity max. And it's just not friendly that way. Now, if you have a larger account, Godspeed.
Can I put this little chart up here for fun when we think about these conversations about Tesla and whether or not it's going to stay a car company? China's EV sales have actually surpassed total U.S. vehicle sales. Those are ICE engines and EVs. So this idea that like China is just going to get into the European market or it's going to be allowed into the U.S. market, I would probably kill the U.S. auto industry. Maybe Trump's onto something there. But this is Tesla's worst. This is the worst thing for Tesla. And that's why merging with XAI is so important for the company, because its margins would absolutely get eaten worldwide. You can't compete with BYD and Xiaomi, right? Given how cheap they produce those vehicles, Mexico is flooded with them right now.
Well, and we know why this
Thailand,
is happening.
excess,
Right?
I believe
Like, this is
excess
why we have
capacity.
anti-dumping
Yes, well,
legislation in the U.S., in Europe, in Australia, increasingly this conversation, because China hasn't had consumer demand for 2.5 years. They're on 8 consecutive quarters of economy-wide deflation. Nobody is buying these things in China, and so they're dumping everywhere because the overbuild is huge.
the overbuild is huge right now. I don't know if there's a Tesla trade in there, Mike. You talk about it being a big product and, thinking about retail traders' account sizes. If you're trading with something 10,000, 25, 50, 100K, taking a position, even doing a simple risk-defined short call spread, short put spread, it's going to still, if you're on a 25K account, it's going to take up 6% of potential account equity on a single position. For a guy who can't stop tweeting, lots on the line there. XLY, of which Tesla is a major component, is continuing to grind to the upside. You see XRT today, a similar type of performance. It's hovering here after a little bit of a breakout. The names that you'd want to see hold up in a risk-on, growth-favored type of market, they're mostly there, right? The only sectors that I think you could perhaps be a little bit disappointed in today, the banks. The banks have been coming off here after touching fresh all-time highs just 3 sessions ago. But that could just be sector rotation, taking apart some winter because banks were literally finished the first half of the year effectively on their yearly highs, and you're shifting into other assets that have underperformed. That's typical for the start of a new quarter for the new half of a year in any event. Mike, talk to me a little bit about the metals here. Do you have anything going on copper? Did you get caught in copper yesterday? I was with Jamal on Futures Power Hour, and he had the unfortunate situation of being in a position while the tariffs were announced.
That is unfortunate, to be sure. I have not traded that HG really at all. I had a micro copper position on. Trying to see what I did here. Actually, no, I had an HG position on back in May, but it was a short put spread. Sorry. Yeah, short put spread, 4645, and I closed it like a week later for a small profit. I think it's interesting, this move and the subsequent reversal, but yeah, I think right now, especially with this move and how big it was, I think it's a hands off for me until it kind of normalizes. I still have that gold position on, but it's probably going to be a butterfly that expires worthless. We'll see. But I've got a downside broke wing butterfly in gold. But yeah, we were joking, like if you've been breaking into abandoned buildings and stealing copper pipes, like now's your time, right?
That's exactly the time. And I'm looking through my own house. I'm like, should I take out the copper pipes? And my wife's like, don't start ripping out the walls, please. What's great about what's really fantastic about these copper tariffs? Forget whatever they do to inflation. They're clearly going to spur a new wave of mining here in the U.S. I'm sure most people know that copper mines, they're basically like planting grass. They just grow out of the ground. Oh no, wait, that's not how they are. According to S&P Global, and this is research as of April 2024, the average lead time for mines in the United States of America is 17.9 years. So we just did an executive order for tariffs to incentivize copper production in the United States. We will let you know the results of this tariff and its efficacy in 2043. Oh crap, this isn't going to solve anything at all.
That is wild.
This really speaks to kind of the political, shall we say, lack of understanding, to say generously, on both sides of sort of the American political conversation, where one side says we need more affordable housing, but then doesn't want to reform the permitting rules to actually get the housing built, and then the other side goes, we need more copper mines, and also doesn't want to reform the rules to get those things built, and so nothing gets built. And so the inventory for everything is low, and the lead times on anything, any kind of construction, unless apparently you're Josh Shapiro of Pennsylvania and you figure out a loophole, takes a gazillion years and a half.
Yeah, people should just do things, and then like ask for forgiveness later on.
We don't do things a lot.
Yeah, I have so many thoughts on this. Google today, OpenAI announced that they're going to be pursuing their own browser, which I guess, everyone and their mother uses Chrome. No one who uses Edge. But it's a 40.4 IVR. We got to be moths drawn to the flame right now. There's just not a lot of volatility in a lot of places. So looking through the Mag 7 names, Meta has a 27.9. Nvidia is on the floor at 5.9. Apple, okay, 25.5. But then Google, it's 40. So I suppose if you're looking for an opportunity, Google presents you with one. Mike, do you have any feelings on Google here? Surely it's doing something for you at these IVRs.
Yeah, I'm gonna be bullish on Google and Apple when it comes time for earnings. I'm gonna wait for earnings though, just to see where we're at with the market. But I will likely do call diagonal spreads in both of them, where I'm selling the weekly cycle where earnings are, and then buying September. That'll give me like a nice 60 days in the long option and a big cost basis reduction in the short. I just think when you look at these huge companies that have not participated in this move, I think eventually there will be a time where there's a sector rotation, and maybe you see some cash come out of Nvidia, go into Google, Apple, something like that. We've seen it before. We'll see it again. It's just, you have to be able to withstand the variance of that and that not happening for some time. But I think given the low levels of volatility in the general market and the fact that a lot of these companies typically post good numbers, it's just a matter of how the market digests it. I think there will be more of an appetite for markets to move higher after these companies release good earnings, if they do, given the VIX at 16. I'm more worried about a situation where, investing in a bullish position in Apple or Microsoft or Google in a 30 VIX is a harder sell. But when the VIX is low and they haven't participated, it feels like maybe market participants are looking for a little less of a sales point to get long.
Some of these stocks, Ilya, that we've just called out here in recent months, we joke it's our all-American profile portfolio. Johnson & Johnson, McDonald's, Philip Morris, Netflix, DraftKings, and Eli Lilly covers you from birth to death and the entertainment that you need in between as an American. A little bit of sports gambling, a little bit of streaming, fatten yourself up on McDonald's, trim down with Ozempic, everyone's happy.
A little bit from column A, a little bit from column B, as it were.
Yeah, right? Have a problem, take a pill, as Job from Arrested Development might say, quickly becoming the reality. You're seeing all these kind of companies, they're continuing just to pump and pump and pump. Netflix was up 1.02% today. Eli Lilly had another good day. It's been doing nothing for a while here, but it's up 1.14%. You're seeing some of these huge names. Microsoft. What's going on with Microsoft here? Another all-time closing high. Quietly putting in the work. Crazy. Why is Microsoft not worth $503.51 a share? Seems perfectly reasonable to me.
It's a great question.
I don't see a reason. Let's go into ticker agnostic land. There is no reason in my mind to think that this is a short, because the price action is just not showing it. But when you look at a daily chart and you see the sentiment divergence, or at least the momentum divergence, name an oscillator. It's flattening. So just in pure arithmetic terms, the capacity, because what does it tell you, right? Let's take a step back. What does it tell you that an oscillator, doesn't matter which one, MACD, histogram, if that's what you like, slow stochastics, if that's what you like. I like RSI because it's a single line that you could put on the chart with a dull crayon. That's my style of technical analysis. But it doesn't matter. What does it tell you that the price is setting higher highs and an oscillator is flatlining? It's telling you momentum is being lost, not hypothetically as a function of arithmetic, because all of these things are just measuring the propensity to close up relative to close down in various different ways. They arrive at the math in a variety of curious ways, but that's all they're saying. Tell me how likely it is that something closes up relative to down, and stick a moving average on it, and tell me what the relative propensity is. So if the price is setting higher highs, but it's losing its ability to close up relative to down, momentum is fading. Now, is that necessarily the indication of a top? Who knows? But it's certainly the indication that the thrust in the move higher is losing steam. And by the way, you're seeing it in the indexes as well. Most ominously in the S&P, you're seeing it on the monthly chart, which has been the precursor of declines in 2022, 2020, 2007. When you see that kind of thing on a monthly chart, it's not great. So any of these names, Microsoft, whatever, is there a reason to short them now? No. But are they telling you you should be jumping in with both legs and buying everything that's not nailed down? I wouldn't do that with your money.
Oh, well, you're not that good of a friend, I suppose. We wind down the show here. Trump is slapping a 50% tariff on Brazil, which is interesting because we ran a $7.4 billion goods trade surplus with them in 2024.
This, by the way, is my only big equity long, is I am increasingly long Brazil.
I got bad news for you, buddy.
It held support today. I actually added on this.
Well, look, the whole, if we talk about the incoherence of tariff policy, because we're entering a potential window where China has lower tariff rates than a number of other countries, which then would incentivize producing more, not less, in China. Slapping a 50% tariff on a country for whom we already have a trade surplus with does not incentivize more production of our stuff here. Doesn't do anything. Does nothing. Doesn't do anything. So
doesn't really hurt Brazil either, by the way, because they're not really a very big trading partner for us, and they run a deficit anyway.
Yeah, and all any of these trade tiffs that we've had with Brazil, China have done what? We've had to bail out our farmers. Like, sure, we've raised. Yeah,
they've encouraged China to buy soy from Brazil. That's really it.
Yeah, like, we've lost significant trade flow with our soybeans with China. Brazil is now literally clearing the rainforest to plant more soybeans to sell to China. And for all the soybeans that we no longer sell to China, what happens to the farmers? The farmers are bailed out. There's an easier thing here. Don't slap on the tariffs that raise $50 billion of revenue, which then you need to pay directly into the pockets of the farmers so that they don't go under. If I could just one more thing about this, how bad some of this policy is. You know what was in this beautiful bill that was just passed, guys? There's an excess food program that we've been running in the country for a number of decades where, like, Kansas farmers, if they overproduce their wheat, they can sell it to the U.S. government at a guaranteed price that the U.S. government then sells abroad, right? Everyone makes a little bit of money, guaranteed production, guaranteed demand for your good, right? If you're going to be a farmer, you got to know someone's going to buy the crops you're going to plant. Otherwise, you don't plant them.
And a boost in U.S. exports.
Boost in U.S. exports, boost in U.S. jobs in middle America. And we just killed that legislation. So
sustaining farming capacity, by the way, should we ever get into a tiff with someone whereby we had to be self-sufficient and didn't have access to export, So a national security thing on top of just generally economic common sense.
Well, not much of that going around these days, particularly here. There's none going on around here, that's for sure. Overtime is out of time for today. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco and Mike Butler in Chicago, I've been Chris Vecchio in New York. Do stick around, though. Ilya's going to be back with Macro Money after a break. I'm around later with Vic Jones for The Price of Truth. Good luck trading. More Tasty Live coming up next.
See you there, everybody.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Do you believe the efficient market hypothesis holds up completely, or do you think that there's some merit to technical analysis?
Technical analysis has some engagement merit, meaning that it might get you excited about doing something, but you can't validate anything in technical analysis. So I'm purely an efficient market theorist. Markets are efficient. I don't care what anybody says.
I think there's definitely merits to technical analysis just from a psychological standpoint, where you see certain levels, you see prices bouncing off of lows or kind of being resisted from higher points. But at the end of the day, you need to prepare for being wrong. It doesn't matter what you're looking at. It doesn't matter what your assumption is or how you arrived at it. You should account for being wrong in that scenario. Basically, it comes to trading small and playing the probability game versus seeing one thing or having one thing and then going all in on that one thing. I think technical analysis or fundamental analysis, if it helps you be comfortable with your decision-making process, then I'm all for it.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home. Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
I think I went down the typical path of investing in stocks, and I was really frustrated in the sense that it was a buy and hope type strategy. And so I was looking at, different ways to learn about options. And I saw Mike and his whiteboard, and it all made sense. There's another world out there with options. It gives flexibility. It's more capital efficient. And tastylive does it again. They teach it in a way that is fun. It's easy to understand, and you're learning from people that have done it for 40 years.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Well, the FOMC minutes came and went, and we did not learn a whole lot more than we thought. And so far, so good, supposedly. But stocks do need a new catalyst. And perhaps one place where there could be a place to look is outside of the U.S., because we do, of course, have a very quiet week this week. So that's what we're going to do here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to do here is consider if we have a little bit of help on the way after some interesting economic data that we saw coming out of China over the past 24 hours, and consider what comes at us downwind, because there is quite a bit more from the world's second largest economy that we're going to hear through the weekend here and into next week. And on that, give perhaps a little bit of context and a little bit of background for the way in which the overall global landscape might be shaping up here. And with that, of course, back our way into a conversation about stocks and the sort of larger impetus for U.S. markets and what all of this might ultimately mean. So let's begin here with a look at what exactly is on the menu here. First, of course, the view of inflation that we just saw over the past 24 hours. And we can see here that we get a little bit of a wiggle higher after 4 months in negative territory on the consumer price index. In fact, it's a little bit stronger than expected, 0.1% month or year on year rather. And it's not, of course, a potent rise in inflation, but you do have to start somewhere. And you could make the argument that there's perhaps a little bit of a semblance of demand returning. China has been a story of anemic inflation for quite a while, as we can see here. But maybe this is a green shoot. And then we look at the data that came alongside, and those types of hopes seem to evaporate. The month-on-month number, 0.1% on the downside. In fact, we've only seen 2 increases in inflation out of the past 6 months. 4 of them have been on the negative, so the dynamics here are not especially encouraging. And then if we look at the level for China's CPI, this is not year-on-year rates, this is the actual index. We can see it's been locked in, give or take, a 1% up and down range here, oscillating for over 2 years. And so this 0.1% increase that we see here looks more like statistical mirage than it does anything that's extrapolating. It appears to be more about a sort of return to average, a kind of retrenchment back toward the mean, rather than in the year-on-year numbers, that is, rather than a something that might suggest there is a build higher in the works. And so when we look at the overall story, it seems like we haven't gone much of anywhere, just saw some statistical rebasing in the numbers rather than marked any kind of a meaningful improvement. Moreover, if we look at wholesale inflation, we actually get the steepest deflation here at 3.6% year over year that we've seen since July of 2023. So again, almost 2 years. Moreover, the pace of disinflation has been or deflation rather, has been very, very steady here for a 4th consecutive month. PPI is down 0.4% month on month. Now, first of all, that's a step deeper into negative territory as compared to the preceding 4 or 5 months. But more importantly, perhaps, what this is a very steady pace that's taking us further and further into negative territory since the beginning of the year. And of course, what all of this suggests is ebbing demand. When prices rise, that is because there is more demand for a given supply of goods at a given point in time, and that bids up costs. That speaks to demand. Economic growth and inflation go hand in hand typically for this reason. But when you have the opposite, especially here, very tellingly in wholesale inflation, so pipeline inflation before it gets to consumers, what you see is waning since the beginning of the year. That speaks to eroding price pressure and, in fact, backsliding in the opposite direction when it comes to demand. This is prices being cut. This is discounting. And discounting speaks to an absence of demand and is aimed at attempting to spur that demand with lower prices. So when we see this slight wiggle in CPI on the upside, it's tempting to say that this is demand. But when you see this occurring at the wholesale level, and this, the story for essentially 2 years' time here, more, it really doesn't strike as the plausible explanation that we're finally seeing signs of life in China's economy. And indeed, last week, the PMI numbers that we saw echoed the same story. This is the official set of numbers from CFLP and NBS. We can see here we're hugging the 50 line on these PMIs. Of course, as ever, 50 is neutral in the logic of PMIs. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is we're basically hugging 50 now for about a year and a half, and increasingly closing in on just oscillating around that level. We're a touch higher than that on the composite, as we can see here, but only just a bit. Yes. The economy is near standstill. It's growing, but very slowly. It's a similar story when we look at the Caixin and S&P Global version of this data. It's a little bit headier in the sense that we're a little bit above 51 on the composite index, whereas we're not quite there on the government version of the data. And in general, we can see this is a little bit more volatile. We saw this decline sub 50 in the prior month. Now we've overshot a little bit into the low 51s, but the trend here is unmistakable. And again, we're hugging that 50 level right down the middle here. And so, and the trend has certainly been lower into it. So economic activity here not looking great and not really going very far. That sets us up for a very interesting set of numbers incoming. We now are looking at these import-export numbers due over the weekend. That'll be a very interesting part of trying to discern where the front running of the tariffs with the U.S. has hit a wall, and the weakness of domestic demand once again starts to overshadow much of anything else. We're going to have a funding data over the weekend into Monday, and then this is, of course, Sunday in U.S. terms, Monday in China terms. And then midweek, we're looking at a first look at second quarter GDP, where it looks like we might see a meaningful slowdown if all of these numbers hold up and all of this type of front running really has run its course and was mostly a story about the end of last year and the first quarter of this year, as of course we saw with such great effect in U.S. GDP statistics and their massive surge in imports and in inventories in the first quarter. Now, the trend would bear that out. Exports for China have been slowing for 3 consecutive months, or 2 consecutive months from the peak 3 months ago, to be exactly accurate. So it does look like you got this surge around the front running of the tariffs at the start of the year, and since you've kind of fallen back to where average was, going back to, let's say, late 2023, start of 2024. And of course, moreover, for imports, we've yet to see an increase in imports for China this year. All of the numbers so far this year have been versions of negative, which really tells you just how anemic domestic demand looks. And so with that in mind, we're looking at a situation here where it seems to be that the overall sort of picture hasn't really improved in any kind of a material way from where China has been over recent quarters. And that doesn't paint a very encouraging story as we get into the second quarter GDP numbers next week. This is a view of China's GDP numbers, nominal relative to real. This is a chart we come back to over and over again as we assess what's going on here. And the main takeaway here is that real GDP is running above nominal. Now, nominal GDP is the value of all the goods and services produced in the economy without taking out the influence of prices. So that includes inflation. To get a sense of what the value is outside of inflation, you subtract that inflation and get real GDP. So when you take the difference between real and nominal GDP, you get a sense of what that inflation coefficient is, economy-wide. And what we see here then is when real GDP runs north of nominal, that means that to get from nominal to real, you have to subtract inflation. That is to say, nominal only gets you higher real if you add to real negative inflation to bring it down to nominal. Or alternatively, take nominal and subtract from it negative inflation, which you can see there's the spread right here. And what this is telling us is that for 8 consecutive quarters at an economy-wide level, prices have been falling in China to the tune of close to 1% of GDP, which is staggering and speaks to a near total absence of demand. Consider how this stacks up with the COVID recession and how shallow of a baby negative reading you get right here. And then consider that for 2 years now, China has been mired in a deflationary spiral that basically speaks to the entire economy having been relegated to the discount bin. There's overwhelming overcapacity relative to demand. Now, we have, of course, seen a tremendous amount of stimulus efforts come out of China, and perhaps they're starting to bear fruit to some extent. We are seeing a rise, finally, over the past 2 months, in the share of new loans in GDP. That's what this credit impulse index is. It is a ratio that measures new loans as a share of overall output. And of course, we've seen that only in the past 2 months has this finally started to perk up. But is it in fact as positive as it looks? Are we actually seeing this money getting deployed to drive demand? And again, looking as we like to do at household bank deposits, the story appears to be no, because the spread between demand deposits, essentially checking account equivalents that are there to be spent, that are callable instantly, essentially the same as cash, and time or demand deposits, essentially savings accounts that are sort of in the realm of CDs where you put money away and lock it up and set it aside, so money that isn't earmarked for immediate consumption. We see there that the spread in favor of savings accounts versus essentially checking or demand deposits is absolutely surging. Here are these time deposits. Here's demand deposits. This is the biggest disparity of this kind as far back as the data goes. And so perhaps, yes, people are lapping up all of the cheap money that Beijing has made available, reasonably enough, of course, but it doesn't look like anybody actually has confidence to consume anything. And they're stashing the money because they expect some sort of adverse outcome downwind, or at least want to be insured against one with as much dry powder as they can be. And this, of course, is where we circle back to the overall global story that then is implied in looking at all of this. And this comes, once again, from the PMI world, and it's a chart that should be familiar by and large, but of course now we have it fully updated for the month of June. And this is comparing the composite PMI numbers for the US the Eurozone and the two versions out of China. Now, here we can see, here's those composite PMI numbers. For China, as we said, the official numbers 50.7, Caixin 51.3. So they're just north of standstill, but we can see they've been hugging that standstill really for at least a year, but going back easily to where the economy basically landed after the reopening from COVID restrictions in late 2022 going into the beginning of 2023. Soon as that COVID rush ran its course and everybody essentially came out of lockdown and all that pent-up demand had its splash, we've essentially slumped back to anchored at essentially barely any growth at all. The Eurozone is in an even dicier spot here, though the latest PMI at 50.2 puts them effectively at standstill. And so the only real growth in town still looks to be the US, where we still have a relatively healthy, if lower, setting on growth than we did at the end of last year. We can see in the second half of last year, US growth was very strong, going back to levels unseen since 2022, and really marking a very stark departure from everything else that we see in the other two major economies. And of course, we know why these three, this is another chart that we keep going back to all the time. This is showing us that 58% of global GDP is just these three economies. China, the second largest, the Eurozone, the third, and the rest of world, largely vendors to the former three. That is to say, they don't have very much independent demand generation that they do. They depend on there being growth and demand in the US, in the Eurozone, and in China to generate the bulk of what they contribute to the global pie. So, with this in mind, here's where those three pillars of growth stand. Two of them are close to offline, or at the very least not going very far, and haven't been basically since the middle of last year, when they both sort of slumped to neutral and where they still hold. Whereas the US, again, although there's been a level shift in growth downward, still seems to be attempting to pull this whole apple cart all by itself. Now, that's well and good unless something untoward happens with US growth. And of course, what US bond markets have been telling us, as we've been saying at length here, is that that's exactly what we're seeing. US economic growth apparently in a situation where the markets anticipate some variety of slowdown, because we've seen that break-even inflation rates, taking us back to that conversation where growth and inflation go hand in hand because it is demand that pulls inflation. We find since the beginning of the year, break-even rates implied in 5 and 10-year U.S. Treasuries have fallen. And that was around the growth scare with the rollout of the Trump administration's tariff architecture. And while sentiment around that story has clearly improved, we can see the S&P 500 was falling with those break-even rates and now has clearly unwound those losses. The break-even rates remain near the lows. They continue to oscillate here at lower levels than they did at the start of the year. Now, that, of course, comports with this step down in U.S. growth and suggests that whatever is happening with U.S. economic activity, it's more so trending toward convergence with standstill in China and the Eurozone than the other two are trending toward convergence with U.S. growth. And this makes for a vulnerable environment because, of course, that means that the global economy as a whole is operating with no safety net, and China is in no position to be an offset if the U.S. economy missteps. Now, it's managing to hold it up for now, But as we look at what the bond market is signaling, as we look at the Fed funds futures contracts telling us that the Fed is going to do at least one, maybe two more rate cuts than they themselves, the central bank that is, have acknowledged, it's difficult not to perceive the risk that the markets are sniffing out some sort of economic slowdown in the U.S. And what the global backdrop shows us is, were that to happen, China isn't coming to help, and neither is Europe. And how you avoid a global recession in that scenario becomes difficult to imagine. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Victor Jones for The Price of Truth on Tuesdays, back with Chris for Futures Power Hour Fridays and Mondays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. Thanks very much for joining. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
What's one thing that traders obsess over that you think doesn't really matter?
Oh man, technical indicators. You can get pretty far in the weeds with those. They're important historical context, but most are backwards looking, and so you got a new picture every day. Every day's a new day, so can't put too much reliance on those.
Maybe it's because I was born and raised by trading the tasty way, but I just can't always wrap my head around like levels and indicators and breakouts and charts and patterns. I'm not saying there's anything wrong with that, but I just don't think for my style of trading it really speaks to me. So that's what I'm going to go with.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Oh yeah. Tasty Nation, good morning.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. Like, losses could have been catastrophic, and they're not. Cool. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so much.
Thank you, man. And I appreciate
Thanks.
you holding on the line to say that to us. So thank you.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
I'm just gonna wait for the stock to dip, then I'm a buyer. Buying into weakness is a phrase used to describe the action of getting long a stock into a down move. It's a contrarian trade. Most people want to buy what's hot, the stuff making huge upside moves, the chart line moving up and to the right. Nobody wants the stock at lows. But it's hard to buy high and sell higher, rather than buy low and sell high. There is a phrase for this. When the time comes to buy, you won't want to.
I got Joe. Joe in Houston, what's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. I think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Craig in New York City, what's up?
I just want to say I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. Like, losses could have been catastrophic, and they're not. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so much.
Thank you, man. And I appreciate
Thanks.
you holding on the line to say that to us. So thank you.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, Shelly Van and Dan Cecilia, of course. How are you both?
Doing well, thank you.
Good. Dan?
Bitcoin all-time highs.
Yes. Ripping higher here. Nice moves in alts as well. We've got a little bit of upside volatility. We've been asleep for some time, banging our heads on the ceiling, I suppose, when you look at Bitcoin at 110. Above it for a moment. We'll see if we can get back there or not. But yeah, new all-time high intraday. Love to see it.
We do love to see that.
Mm-hmm.
So we're feeling good. A little bit of excitement. It's in the air here at Tasty Live. But we're not going to talk about Bitcoin, at least not right away. We're going to jump right into this, and we have a special show planned, I suppose. There's a theme today. Stablecoins.
Mm-hmm.
So if we can jump into our slides here, throw up our stablecoins, and let's talk a little bit about what they are, given we've hinted at this on the show, but very soon we're going to offer stablecoin support via Zero Hash at the Tasty Trade brokerage. So that's very exciting. A lot more detail coming soon. So look for that over the next couple of weeks. But ahead of it, wanted to dedicate a show to really just talking about stablecoins. I think, given our experiences on chain, I think it's fair to say that we're all users of stablecoins, but maybe not everybody is. And this will be a good primer to kind of get some familiarity with this technology, really.
I want to hear from the chat. Has anybody in chat used stablecoins?
Oh, it's a good question. If you're not in the chat, what are you doing? Get over to YouTube, Tasty Live, streaming live. Type some crazy shit in the chat, or maybe answer Shelly's question.
Stablecoins. So Ryan, what are stablecoins?
Yeah, let's jump into it. I think you've got to look at this really simply. Without getting into all the technical details, what we're talking about here is just simply a dollar represented on a blockchain network. So this is a token that maintains a fixed value of $1 by being backed 1-to-1 with reserves like US dollars or short-term treasuries, right? Very short-dated maturities there, treasury bills, fungible in that sense. And so you have these stablecoin issuers. We've talked about Circle, just went public. We've talked about Tether. PayPal has a stablecoin. Paxos provides stablecoin infrastructure. There's many others, I believe, Trump, US dollar one, World Liberty Financial has a stable coin. There's a consortium of financial services companies. There's the US Dollar Global Network, I think it is. There's a lot of stable coins out there, actually. And so you have these stablecoin issuers. When someone deposits money with them, maybe it's a platform that provides access to stable coins. An equal amount of stablecoins is going to be created by that issuer or minted on chain. And then whenever these are redeemed for fiat currency back into a traditional bank account in that sense, the stablecoin tokens are burned. Maybe that's all you need to know for now about the technical side of this. What's your favorite stablecoin?
I
Chat,
used.
Cave,
Oh yeah, in chat.
Studio.
I use USDC.
Yeah.
USDC or Athena, which is yield bearing.
Ooh.
Do we even get into that today?
I don't think we can get into that today, but I do believe there is a video on Athena on the Tasty Crypto YouTube. So if you get over there, also subscribe to that channel, you can see that video
Some
in
good
the archives.
foreshadowing though, Dan.
It's good foreshadowing.
Yeah, that was nice. But we'll have to talk about that at some point. There are a lot of different stable coins, algorithmic stable coins as well. You have these kind of yield-bearing stable coins. And, when you look at the legislation, not to get into the details too quickly, but the stablecoin legislation that's pending, making its way through Congress here, does not permit those stablecoin issuers to pass on that yield to the end user. But I think there could be a world in which that happens at some point. So there's a lot on the horizon, I would imagine. But today, there really aren't any yields to be generated by just holding the stablecoin on chain yourself. There are certain platforms that might give you rewards, such as Coinbase for holding something like USDC, but the yield from those treasury investments is not passed on to the end user in most cases. So To recap, very simple. It's just $1 on a blockchain network, and these are on many different networks. We'll show you the biggest in just a second. But I want to talk a little bit more first about why does this even matter? We have digital dollars. It's really easy to send money to each other, and in some cases almost instantaneously if we use Venmo or we use PayPal. Why does this matter? Do you guys have an opinion as to like what the most important aspect of this is?
I think it's international, globally connected, international, 24/7 instant dollar rails. That was word jumbo, but like it matters internationally.
Yeah, I think it matters internally as well, but I think in the U.S. we take for granted that, you know, we're sitting here with USD is like the top currency in the world, and in other countries, their currencies aren't stable. And so you could wake up and it's like, oh my gosh, my native currency is worth so much less. Having something that's stable and having access to it. Or I know stable coins are huge in Africa. Like if you live in Nigeria but you need to send currency to Kenya, there's not always a rail to do so, and it can be really cumbersome. So having something that's just instant, cheap, and stable, it's a huge game changer.
Yeah, I think we're going to see the continued growth of stablecoin market caps because there is that demand for dollars that exists globally, as you mentioned, Shelley. And to your point, Dan, I mean, it's really just that it's instant 24/7 settlement. This is technology at work in the financial system and an evolution of how things kind of move around here today. Again, it's not to say that the existing system doesn't work. It just can become more efficient through this technology. And so businesses can send cross-border payments instantly 24/7, as we talked about. Doesn't necessarily need to rely on legacy banking rails. It doesn't replace SWIFT or anything like that entirely, but doesn't need it at the same time. You think about, you know, settlement. In some cases, you might have a company that's going to float you a balance. You have instant BP at tastytrade. Sure. But to a certain point, there's a limit on that. The fund transfer, the settlement process, that's not instant. It can take days at times. And so again, that's the key here, that this allows for instantaneous settlement, near instant settlement. Maybe it's a second or two, right? Depending on the blockchain that you're using. It's low cost and it's 24/7. The internet's turned on. This works. You look at companies that need to move money around, need to pay their employees, need to pay their suppliers. This cash flow, you know, quite often, sometimes you don't get paid as a supplier for 30, 90 days. This eliminates intermediary banks. It's going to lower costs. It speeds up that cash flow. Operationally, it's more efficient for companies compared to the SWIFT system or traditional bank wires. And so I think that's the key here, is just how much more efficient everything can possibly become initially, right? When we think about the next 6 months, you get this legislation that passes, you get more adoption, participation in this system. I think it becomes commonplace. But initially, the huge benefit is really around instantaneous 24/7 settlement. We're going to talk about how this evolves into a broader kind of benefit to the financial system. But when you think about cross-border payments and, you know, companies and how they currently move money around here today, that's probably the key takeaway. You talked about this in some ways, and we'll talk about global dollar access in a second, but this makes remittance payments for people a lot cheaper, a lot faster. It's as simple as that. You use Western Union or MoneyGram or another service, you're going to pay a fee. It's pretty hefty, 5, 10%. Might take a few days. Not as relevant to us unless you guys are sending money to people around the world. I don't know. I'm not, but for a lot of people that are, this is a much better solution, assuming you have access to those stable coins.
Yeah, I mean, for me personally, when I'm in crypto and, you know, I want to do something with someone online and, you know, I might not know where they are, they have a wallet address, they accept USDT or USDC, maybe they're a talented designer or a talented developer. Mm-hmm. They want to get paid in USDT or USDC. And it's easy to come to that agreement. Like, I don't need to do a MoneyGram or a Western Union. Like, it's just instantaneously there. They trust it. It's liquid. There's a demand for dollars in these countries. And sometimes they're really most of them are really talented, and they need a chance. So I think in an online, instantly connected world, people want US dollars. You want them to do something for you. This is how you compensate them. And most people accept it if you're a crypto native. So I've experienced that personally, whether it's internationally or domestically. If you're doing something in crypto, work, development, code, design, they want US dollars, and I send them stable coins. So there is an economy. It happens in chats. I think maybe you've experienced this too, Shelly.
Oh, yeah.
So I've seen it firsthand, for sure.
I've been on the receiving end of it as well. I was doing business with a company in Switzerland and getting the intermediaries of, the wire transfers, the currency exchange. By the time I would receive the funds, I had paid hundreds of dollars in fees to get my payment. And then we were like, forget this, pay me in USDC.
Yeah, right. It just makes sense.
And it would take weeks sometimes if things got hung up. And I was like, why is this difficult? Like, where did the money end up? And then you're on the phone like, oh, okay, there was a hiccup in whatever process here. But no more chasing money or paying extreme fees.
Yeah, initially, part of the allure of blockchain, of Bitcoin, ETH, you could send payments or send value across these networks using those cryptocurrencies. But now that you have tokenized dollars, you talk about real-world assets. This is the biggest real-world asset on chain today is the US dollar. It just makes everything much more efficient, much easier, just kind of makes sense, in my opinion. So you get legislation in the US and elsewhere. This is only going to continue. We'll talk about the market cap and the potential growth of it in a second. We've hit on remittance payments, cross-border transactions, improves kind of operational efficiencies around cash flow. A couple other things I want to hit on really quickly, and one is very relevant to us as traders at tastytrade. But first, it's increased banking access. We talk about the unbanked, the democratization of finance and banking services. This improves that. This leads to more access for more people. All you need is a smartphone, internet connection. You can access the digital dollar economy. It doesn't require a traditional bank account. Now, that doesn't mean, I think when people hear that, they think, oh, it's money laundering or, it's black market, it's bad actors. Not at all. It's just that you don't have to go through that existing process today, which is not accessible by everybody and certainly not accessible depending on where you live globally.
I think a great example is women in Afghanistan. A lot of them don't have access to banks. So if they're doing something where they can work online and receive payment in USDC, that's theirs.
Yeah, I think there'll still be some element of KYC. There's still oversight, surveillance. You still want to protect against money laundering, and you want to make sure that those providers of these services, are adhering to some regulatory framework. But it opens up access significantly to everybody that wants to participate in this digital dollar economy. And I think the key word there is digital, that's globally connected and almost ever expanding. So it's huge for the unbanked, and is also obviously going to play a much bigger role as you see it, a larger and larger part of the global population even go online. I think people miss that too. You have 8+ billion people globally. Well, not all of them have access to the internet. There aren't those services, but that's growing as well. So increased banking access is key. And I think as it relates to us, you think about the adoption by financial institutions. This is going to provide banks, brokerages, payment platforms with programmable real-time settlement infrastructure. That's a mouthful as well. That ultimately just lets people fund their accounts faster, cheaper versus legacy systems. If you think about markets that are moving towards 24/5, 24/7 maybe, but 24 hours a day, the majority of the time, you need payment rails that are also running 24/7. Even today, let's say you get a big move in a commodity like oil, or the S&P is down a lot overnight on Sunday, or we know that it's going to open when the futures market's open on the weekend. It's going to open down a lot. You want to take advantage of that. You want to trade. Well, you don't really have a way to deposit funds into your account so that you're ready to go and you can trade. Maybe you had a balance that was available from the previous week or on Friday that you took into the weekend, but there's no easy way at all here today, for the most part, to instantly make those funds available. There's instant BP, but maybe you need a little bit more, or maybe you just want to use this system. So I think it's a huge benefit to anybody that is trying to trade 24/7 markets like crypto or 24/5 like futures. Very excited to see that at Tasty Trade. That said, just want to talk through it. If maybe you guys want to speak to some of the bigger stable coins that are out there. We've talked about USDC as something that we've all used here. It's not the biggest. USDT, which is US dollar tether from the company Tether, makes up 60% of the market. But you can see just how dominant here USDC and USDT are as those kind of first movers in the stablecoin space.
It's kind of interesting of all the other competitors that are making up that 5% or 10% of the rest of it. I see DAI in there. I see USDE, PYUSD, which is PayPal. Biddle. Is that BlackRock?
It's like build, but buildle, like hodl.
Yeah, I mean, I think Tether. So what's interesting about Tether, I think, too, is Tron, the chain Tron, accounts for most of the Tether flows. Like the entire chain is just like a Tether chain. And I think, yeah, I mean, Tether is probably the most trusted globally. I think USDC is getting up there, but most people use Tether. So,
yeah, and I would expect that to continue, but I think that you will see USDC market share increase and percentage of the market might grow as well. They might grab some more market share, but I should say the market cap increase of all of these tokens. Let's just take a look at market cap here so everyone can see just how quickly things are now starting to move. You go back to early Ethereum days, kind of really get DeFi summer in 2020. Stablecoins start to play a role there. You get up to, we have a dip with the FTX collapse, but you see a lot of growth in terms of the overall adoption and total market cap here. And then you get to where we are today, which is a market of 255 billion. We talked about Tether's dominance around 2/3 of that market. I would suspect or expect that this is going to only continue to grow. For further context, I guess let me just jump ahead here. Here's the market cap of stablecoins. So we'll look at it, $250 billion. Total crypto market cap. And this is what I always love to see because people are familiar with crypto. We talk about it every day here on Tasty Live. It's in the financial media now, right? It's reached in some ways mass adoption, but it's tiny. And that's what people miss. Yes, Bitcoin has been around for a while, ETH as well. People are maybe familiar with Solana, XRP, a handful of other tokens, and maybe have gone on chain and done something in DeFi. Maybe are using stablecoins. Maybe. 3.5 trillion. The global equity market. This is not that big either when we really start to look at everything. If you include derivatives, currencies, global wealth, I couldn't put it on the chart because when you have another bar that's 800 trillion representing global wealth, the stablecoin isn't even going to register here. It barely does when we look at it this way. But global equities, about 124 trillion. It's going to fluctuate, obviously, as prices move around. But if you look at the last year or so, around 120, call it trillion. Crypto's only 3 trillion. So can crypto get to 10 trillion? I think so. Can it get to 100 trillion? Maybe. But again, you go and look at global wealth, financial institution assets globally, et cetera, derivatives, currencies. It's much, much bigger than just the global stock market. And crypto is still very, very, very small. So I think stablecoins could easily get to 1 trillion sooner than later. I used to say, okay, at the end of this decade. I think it's probably within the next couple of years.
Yeah. Mm-hmm. I mean, I think that Circle going public and the integration with Coinbase or whatever that deal is, I think that accelerates some of it, at least in the States. But Tether, just some of the stuff, if you pay attention to Tether that they're releasing, it's not even just like US dollar Tether. It's other currencies. It's gold. It's tokenized commodities. I mean, they're investing in everything. They're doing baskets of agricultural commodities. They're investing a lot in South America. So
Yeah, I think that's a good segue into this. I mean, what you're alluding to is the tokenization of all financial assets. You know, we can call it tokenizing everything. Everyone wants to point to assets like real estate on chain or fine art or whatever. But I think let's just start with dollars, equities, and U.S. Treasuries. Those markets are relatively large. This is what happens next. That's my statement. This isn't like maybe this is what's going to happen. This is what happens next. You're going to see tokenized equities become commonplace. We had the Robinhood announcement. There's other platforms that are doing this. It's early. You need the entire system to adopt this technology. It will. It's superior. Things will settle on blockchain networks. There will be private chains. There will be KYC. There will be other elements, certainly, that exist within the current system, but it will leverage this technology. You'll have 24/7 trading and instant settlement. It's going to be globally accessible. We talk about global demand and accessibility for dollars. Well, these are just dollar-based assets, right? Token is a wrapper in some ways. So it's going to be globally accessible. Presumably, again, there will be rules. You will have to know who your customer is, but through this technology, it just opens up these markets in ways that there's a lot of friction today. It doesn't mean that you can't trade U.S. equities if you live in Singapore. Clearly you can. This just makes it a lot easier, a lot faster, a lot cheaper. These tokens then become programmable or are programmable, right? Dividends are automated, voting rights, KYC. There's a lot you could do. That's not even getting into how this can be used as collateral in DeFi, or you could have USDC on one side of your liquidity pool and an Apple stock token on the other, making markets, facilitating the trading, providing liquidity, and as the end user generating fees or yield as a result. So stocks are already here. U.S. Treasuries are already here. Imagine real-time yields. Instead of once a month, you get that coupon payment every day in some cases, depending on what the investment is. Fractional ownership, you could attach, the yield to much, much smaller capital investment. It's globally accessible. There's always the story about, right, the Chinese are dumping U.S. Treasuries and all of these other countries hold all of our debt. What if they all sell it at one time? The reality is there's increasing demand for dollar-based assets in this system, and there are a lot of buyers that this, opens that treasury market up to as well. And I think the other thing to consider, I heard this the other day, is just kind of coming at it from the perspective of like democratizing the risk-free rate. We're all about access and kind of removing barriers and borders in some ways. But when you think about just the ability to access the U.S. Treasury risk-free rate as an investor and how many people are unbanked, they're not even able to participate in that fairly privileged system, that we're able to easily access. And so the U.S. is going to be able to issue a lot of debt, and there's going to find that there's a lot of demand for it when you have these rails and this technology that's underpinning the system. So just wanted to speak to that really quickly here at the end and hit on this is what happens next. Stablecoins are first. Legislation is coming. We do have crypto week.
Crypto?
Yes, Shelly, can you talk about this real quick?
Let's hit on this real quick and we'll wrap up.
Yes, really quickly. So if you're not following Tasty Crypto on X, get over there and do it. We're dropping everything you need to know leading up to Crypto Week this Friday morning in a nice, comprehensive Twitter thread that is very easy to understand. Crypto Week is next week. 3 bills, 5 days, big impact. Let's go.
I love it. It's being billed as if it's like a music festival.
I know.
Or something.
Clarity Act, the Genius Act, and then
anti-CBDC. We don't want the government in our stable coins. So anti-CBDC, that's central bank digital currency surveillance state act.
It's a mouthful.
Yes.
I do wish we should have done something like some type of like Crypto Week reward, or like if you tune into our show during Crypto Week.
It's not too late. Catch us on Beans Friday morning.
Hint.
There you go.
Yeah.
All right. Well, stay tuned for Beans on Friday. Stay tuned for Crypto Week next week. That's going to do it for our show here on Stablecoins, special edition. Stablecoin support funding coming soon to Tasty Trade as well. So stay tuned for that. But that's going to do it for the Tasty Crypto Show for this week. We'll be back on Monday. Until then, I'm Ryan.
I'm Shelly.
I'm Dan.
Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. And I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Oh, yeah, it's Wednesday, July 9th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast, your little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. More on that in just a bit. For now, let's introduce our very special Wacky Wednesday guest. I'm talking about none other than Chris Vecchio. Chris, how you doing, my friend?
I'm doing all right, Vic. How are you today?
I'm all right. You're developing any new skills you've been developing lately? You want to share with me or the audience?
I'm working on my snaps and my whistles and my mouth pops.
Yeah, you know that can you do that big loud whistle? I've always wanted to do that.
Oh God. So, my dad can, and like now that I'm going to have a son, it feels like I need to know that till I call him back in the house. So
call
like
him
a dog
in the house. Yeah, I do this thing with my son. I just go,
you take your kids outside. Come back for dinner.
I do.
I do it with my cat.
No, it does feel very much like a cat or a dog thing. But so that's if we're out in public and it's hey, don't do that. That's what I'll do. But it's like a whisper shout, So other people don't know what I'm doing, but my son, he'll know, and my daughter knows. You can use that if you want.
It works with the cat, so I'll keep it there.
Do you have cats?
Just one.
One cat, no dogs?
No dog. No dog.
You would be a cat lady.
Yeah, well, the real story, actually, I'm going to turn this on you. The real story is that I wanted a dog, wife wanted a cat. Sister-in-law got cancer, got my wife the cat to make everyone feel better in the house. So you're a jerk.
Yeah, you did turn that on me. There's nothing.
You jerk. Boo.
Well, best wishes to both your wife and your sister. I love you as well, Christopher. Somehow
what
that's
about my
the cold
cat?
open.
I don't like cats. I'm so. It's not like I'm so neutral on animals. It's not even funny. You know, like I'm unable to form like some sort of connection with an animal. It's just like it's like a bottle to me.
Well, you have that advent calendar of all the zoo animals. You're like, I've eaten this one. I haven't eaten this one yet. Got to try that one.
I have
You
had a
showed it to me.
kangaroo. I have had a kangaroo burger.
What's the most exotic animal you've eaten?
The kangaroo burger. No, I had horse sashimi in Japan. That was wild. Served over like chives and onions or something like that. It was delicious. And I don't know, my ex-girlfriend's father, she worked at a golf course. He would go to that golf course, catch bullfrogs, and then grill them up. So I had, home-caught bullfrog legs as well off the grill. What's the most exotic thing you've eaten?
Probably peacock.
Whoa. I feel like you're a monster. Aren't those things like endangered? How'd you eat a peacock?
In Italy. I'm trying to progress to ortolan, but my birthday's next week. If anyone wants to get me an ortolan for my birthday, I'd love to eat it.
That's the cold open, everybody. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. Make your life just a little bit better. Hit the like button if you haven't already. And if you want to be part of the chat box, that's somewhere on your screen probably already. And if not, it's in the middle of your screen now. Do us a favor, head on over to Tasty Live's YouTube channel, the evil Google YouTube, and subscribe to the channel. And you can basically live stream your thoughts directly on this stream. Chris, off and away we go. S&P 500, a little bit lighter than the last time we talked, under 6,300, but still at 6,260, only 40 points lighter, but up 0.2% on the day. NASDAQ up 0.75%, the Dow Jones up 0.5%, and the Russell outperformed again, up a little bit more than 1%. What say you, my friend, on risk today?
It's a typical summer day, right? Low volume, low volatility. The market has no reason to overreact to Laotian or Kazakhstani tariff rates, or even Brazilian tariff rates at 50%.
Brazil was kind of wild.
Yeah, well, I particularly for the rationale about it all. I distinctly recall a speech that President Trump made in the Middle East a few weeks ago about how the United States was done meddling in other countries' internal politics. So color me shocked when he used a very legitimate court case against former Brazilian President Bolsonaro as a rationale for jacking up tariffs to 50%, which on Liberation Day, they were 10%. And do we have a trade surplus with Brazil? Yes, we do. So, okay. But the tariff talk, right, like at this point in time, if we're going down this path, the market has probably priced this in because we've been hearing about it for several months. And like all other events that come and go, we price them into a certain degree. If it's a regional bank failure or even the October 7th attack of Hamas against Israel, the market eventually benchmarks something and says, okay, we'll figure out a way to deal with this. So stocks right now, is it a chicken out situation? I take issue with people calling this, well, Trump's just going to chicken out. Trump chickened out because of the bond market. Bond market's not freaking out right now. So he probably thinks that he can get away with whatever he wants to do. And it's only once the market freaks out does Trump back off. So this game that we're playing right now of literal chicken, right? Like the tariffs are coming, okay, but he's going to back off. Otherwise, we're going to go down. Well, he's only going to back off if you go down. So who's going to make the first move? And we're kind of in a holding pattern right now. So we're going to float up here for a little bit. July expiry, as Tom recently pointed out, which some might say is a seasonality reference, but others may not. I would say that we would see that the market still stands on pretty good feet until about next Friday. And then you can get a little rocky there. And then August and September have their usual can of worms if you are a seasonality person like I am. So maybe we have a little bit of a last puff higher here. 6,400 in SPX for between friends, and then we call it a summer for a few weeks.
Where are you pulling those numbers out? You just random? 6,400 just sounds good to you? It's a nice round number.
Yeah, when I go onto the Tasty Trade platform and put SPX in, the chart's auto scaling from 4,800 to 6,400. So,
So you just bonds at 114, kind of an ugly last, I don't know, 4 sessions or something like this. Backed off of 115. We're now at 114, which has been the point of control. No surprise there. Nice little 1-point rally here today to get us back to 114. What are your thoughts on the long end here? It's been much more subdued trading. I'm obviously across everything, man. It's 0.5% moves every single day. Vol just got crushed today in the equity market, and bonds were at 114, which have been a snooze fest in bonds, honestly. But I want to talk about bonds because I want to get somewhere off of the movement in the long end of the curve. Your thoughts here? Are you doing anything? You long, short, anything here?
In notes, I'm still directionally neutral, which, despite all the excitement over the past few days, it really just erased the rally that we saw in the 5 days preceding it.
Mm-hmm.
And so we're back to basically the midpoint of the year-long trading range thus far in notes. And so being directionally neutral right around 111.5, it's just playing for the market to basically stick around 111.5, give or take half a point, go to 112, go to 111. As long as we're bouncing around between there, it's been very effective. And if you wrote it out through early April and then the pullback thereafter, it's again been a very effective trade. So I'm still leaning short iron condors in notes. I don't see a reason to do anything else there. It's not the sexiest trade because there's not a lot of volatility in the market right now. But with bonds, it's a little bit of a different story because you can see there, and I should pull up the screen. You have ZB open, okay. Before the decline, right, you get what's that 3 candlestick pattern, big green up bar, doji, and then the red down bar is an evening candlestick cluster. That is a topping pattern, and it's obviously followed on with continuation to the downside. So that occurs all right around the passing of the one big beautiful bill. Debts are going up, deficits are going up. Is it for something that's long-term beneficial for the economy? Like, will this boost growth longer down the line? The fiscal multipliers, are they positive? And the answer is no, not really. The bottom 80% of income earners in the country are going to effectively see a tax hike, and the top 20% of income earners are going to see a tax cut. So we're going to be running up deficits and debts for something that may not help the consumption, a fair amount of consumption in the economy. Okay, so the market takes issue with it for a few days, but the real litmus test is not the narrative that I'm saying here. It's whether or not people actually want to buy bonds and notes at these levels. And yesterday it looked a little iffy because 3-year note auction wasn't great, but the 10-year note auction today was fine. Stops through, the bid to cover ratio is above the 6-month average. Foreign demand is up, highest level since November 2023 in terms of indirect bidders. And so, sure, if you have a good 10-year auction today and a good 30-year bond auction tomorrow, on the heels of the one big beautiful bill that's going to blow up the deficits and debts, clearly people don't give 2 hoots. This would be the first litmus test to say that, it's not that problematic, and more of the same continues.
Big beautiful bill was priced months ago, bro. Nobody cares. Bonds go higher, yields go lower.
And the Fed you can talk about the copper tariffs yesterday. Does that prevent the Fed from cutting? There's a policy institute, VoxEU, their CPER group, put out a note in December of 2024 about how copper tariffs and price shifts in copper, generally speaking, impact inflation. And in the developed Western world, like the United States, Canada, Western Europe, et cetera, a 10% increase in copper prices leads to a maximal 0.05% increase in headline inflation 24 months later. So at the margin, do the copper tariffs hurt or help the Fed's case to cut? They probably hurt it a little bit, but does it derail a potential cut in September? Absolutely not. And ultimately, I think that's what the market's going to care about. You're going to have no cut in July, despite a few Fed officials like Waller and Bowman calling for it.
I think that makes sense, though. Don't you think that makes sense? If they're going to cut in September, you have to have some dissent in July to signal to the market that they're getting ready to move.
It feels like a redux of last year.
Yeah.
Where, the Fed's not going to cut in July. You're going to get a bump of bad data in late July or early August. and the market's going to go, oh, geez, the Fed's late. And then they come out in September and, we have a conversation after Jackson Hole. Did they just prep the ground for a 50 basis point rate cut?
No. No, they won't do that again this year.
I would agree, but I wouldn't write it off.
I wouldn't either. It's a live probability. I don't think they will, though. Because I don't think they want the long end to lift.
On it.
I don't think they want the long end to lift.
That's the story for the long end here. They're not going to cut in July. And then you take what Scott Besson said, meet the new boss, same as the old boss. He's just going to apparently pull a Yellen, which is to say that they're going to cut Treasury issuance at the long end of the curve and boost issuance in bills to take advantage of the relatively shorter, lower end rates in order to kind of wait out for the next Fed chair to come in play. So no July cut, maybe the lack of issuance at the long end of the curve when we get the next QRA. Maybe that lack of supply around the corner helps keep a lid on bond yields because, demand outstrips supply at these rates. But it's stability. And I think that's the point here. The point here is that yields are probably going to stay range bound and choppy and meander around for the next several weeks and months. I know ZB is the future story, but if you look at TLT, Victor, and you pull up a monthly chart going back to 2003, you'll see that we're sitting at basically the same levels we were at going all the way back to 2006. These are multi-decade lows right now in the ETF product. So if you're trading around this, right, there's reasonable, sizable support nearby to work around. The question is whether or not the volatility with a sub 10 IVR makes it worth it to take shots with long deltas right now. And, maybe put something in your pocket that's a little higher convexity, a little bit out of the money, a little bit longer duration. That way, if this thing goes sideways one way or the other, you got something doing.
I kind of like that. The reason I wanted to set up the discussion on the long end was the move in home builders. And I'm kind of obligated to talk about these because I unfortunately made this audience listen to me drone on about home builders for like a month. And so now it's starting to perform. So I have to bring it up. DHI, so DR Horton was one of the top performing, but a ton of these performed today. Lennar, KB Homes, Pulte Homes, all this stuff was up another 3 to 5%. So we're getting these moves, man. And when they're coming, we're not just like sort of drifting higher. We're getting 3 to 5% blasts in these home builders. And I think people are starting to figure out, either the technicians are figuring out that these things are based a little bit. I think there's a little bit less fear in the long end. I think people are starting to price out the probability of a long end lift on a cut. So I think all of these things are positive. Do you have any thoughts on either the home builders here and how you see it as a theme on post, September cut?
I have a very difficult time thinking that home builders are going to see a sustainable bounce. I'm very pro. I think the home builders, and the REITs should do well, but I prefer REITs over the home builders longer term, if only because of the legislation that's in place right now that makes it all the more difficult to acquire materials at low cost for labor. These are all factors that go into the equation. Likewise, you're seeing more signs of consumer distress in the market and people lowering their financial expectations moving forward. So that doesn't exactly speak to a strong environment for home builders, particularly one in which, when we have the largest gap ever recorded between people who are in the market looking to buy versus those homes listed for sale, according to Redfin. Right, there is a massive oversupply at these levels. People have been waiting for rates to come down to clear the market. We've talked for a long time about the golden handcuffs that low mortgage rates have done for a number of people in the post-COVID years. And so, we've seen refinancing. Every time mortgage rates drop, just like 5 basis points, refinancing shoots up. People are desperate to get out of high interest rate obligations. So I don't know, Victor. Home builders look really nice here. They've had a really strong rally. I question whether or not there's enough here to continue to chase this to the upside. I prefer REITs still, even if they haven't done well in the preceding 1 or 2 weeks compared to home builders.
Mortgage application purchase index was up 9% this morning, year over year. Refinancing it was up too. Yeah, maybe you're right. But I really think at these levels you're getting a really, really interesting valuation. These are super low single-digit valuations, most of them. D.R. Horton's a notable exception. That's a double-digit one. But I think it's a really, really interesting setup here. I think it's a really interesting setup. I think the narrative is going to be horrible on the housing market for the next like 3 months, maybe 6 months, and it's going to confuse a lot of people. Why are home builders going up when the housing market's so horrible? And that's why I like this super sick trade. But I will move on here. I will let this go. Do you think there's complacency in the equity market at starting to get into a 15 handle? What would you say? You think this is just, like you said earlier, the summer trade, or do you think there's complacency here? Do you think we're past the big beautiful bill? We're past some of like the tariff uncertainty, and you think the market's like looking ahead here? Do you think there's complacency in the marketplace, or do you just think we've gotten past a lot of the big issues here, the 12 days war, everything like that? How would you characterize the market right now?
There's like a period of transition where it's like, oh, this is a relief rally. And then there's like that moment in time where it's like, okay, we're no longer rallying because we're putting this bad thing in the past behind us. And we're rallying to the degree that we're now underweighting risks in the future. Okay. And I think that we may be arriving at that threshold. The market to me is, if it follows the path that I think it will, and hopefully, given how I've been trading around it, we peak in the next few weeks. We step back for a little while. We get like a 5 to 7% correction in stocks, maybe a little bit more in some of the higher beta names. And then we get our typical year-end rip. And if that's October basing or November basing, and then rally into the holidays, there are a few things that just kind of stand out to me that don't read well right now.
Like what?
The National Association of Active Investment Managers, NAAIM, their most recent survey produced a reading of 90% or greater in terms of being invested long. Over the past 10 years, you look at instances when the NAAIM survey has been north of 90%, and it's usually in the neighborhood of a top, where you're getting a pullback of 3 or 4% over the next month. So we have one thing going there. We also have bad breadth in this market, right? Mm-hmm. The way that I would define breadth in this situation is how far the S&P 500 is away from its all-time high compared to how far the median S&P 500 stock is away from its all-time high. And that's near 15% right now, that differential, right? The S&P 500 is sitting at all-time highs, but the median S&P 500 stock is still sitting about 15% below its own all-time highs. And so when you see these kind of divergences form, it speaks to a market that's losing steam. And while we haven't seen it the case this week so far, there were little inklings of it in the last week or two. When the market starts pushing those all-time highs and volatility stops falling and it starts to tick up, tail wagging the dog scenario where it's actually the out-of-the-money call option buying as people chase the market higher that pulls up volatility, right? You throw that into the mix a little bit more, and you could say that we're pretty close to exhaustion right now. So I'm still a bull. I think the market will close higher at the end of this year, given what I know right now and the information I have today. I think the market's going to close higher this year than where it currently sits. But I don't think that's before we see another pullback of, again, 5 to 7%, maybe 10 in something like the NASDAQ.
So what do you do with that?
I think that the August 12th deadline for the tariffs are very dangerous. It makes absolutely no sense. And then again, people have tweeted at me. They've emailed me. The emails are a lot less TDS and more supportive these days. So I appreciate that. It's good for my own psyche. But they're more like, Chris, you keep complaining about this tariff policy being...
I just caught what you said.
You don't need to try to make sense of this policy. It's not coherent. You keep saying it's incoherent, but it's never going to be coherent. It never has been, right? And like to a large degree, I agree with that in my perhaps in my soul, but I'm in trying to stay objective here. Does it make sense that we're going to have higher tariff rates on other countries above China? If the whole plan is to ring fence Fortress America and to protect the Western world from Chinese overbuilding, excess supply, dumping on global markets, right? Well, then why would you employ higher tariff rates on those other countries? You're going to incentivize Americans to buy more from China, which encourages companies to build more in China. So August 1st to me is not the deal. The deal is August 12th. When we think about the purchasing schedule for people who are stocking for various companies like a Walmart, you usually have your purchasing window for the holiday season is April through June. We delay the tariffs on China in the middle of May. So the window with which these companies can stock the shelves for the biggest consumer season in America, Christmas, Hanukkah, Kwanzaa, New Year's, whatever you want to call the end of the year, okay? I don't know the audience. We will say that you have to place those orders by the end of May. And Trump took the tariffs off and did the delay during the ordering season peak. But if he puts them back on in August or September, little Timmy or Tina's not going to have to worry about having 20 or 30 fewer Barbies come this Christmas. It's just not an issue. So he can actually squeeze and turn. And the reason why that makes it so interesting, if you're looking for trying to time out being bearish for the second half of the month, the Fed does not meet in August. They never announce policy at Jackson Hole in significant when have they cut rates at Jackson Hole? They'll maybe do something like average inflation targeting framework adjustments, but they don't actually cut rates. So then you get into a window where the market's like, wait, the tariffs are real and they're happening and they're effective immediately. And the Fed's not meeting? Okay. So I can paint a picture where August 12th onwards, there's a window where the tariffs are real and it's not a taco trade. The market has to wake up and go, oh, geez, Trump can't chicken out unless we panic. We have to panic on this so he chickens out. So volatility's low, maybe like in August 30, look to late August, 3 to 5% out of the money, long put spread, cheap, 10 to 1 risk to reward, like a 20% pop. Have it in your pocket. Trade tactically long over the next week or two, but keep that little bit longer duration. Put spread in your pocket.
The only problem is, and it's not a big problem, but as you would expect, vols bid up in late August to September. Why do you think it's not coherent? To me, it makes total sense what they're doing right now. To the extent they got some people to the negotiating table, they and negotiating in good faith by their standards, they get the universal 10% tariff rate. To the extent that they don't feel some countries offering them what they want, they put on max leverage right now. And to me, I'm like, yeah, I understand that play. I don't have to like it. I don't think it's going to be, growth inducing to the U.S. economy. But I get what they're doing. Why do you think it's completely incoherent?
No, when I mean incoherent, is it's incoherent. What's the primary goal? If the goal is simply to, again, fix trade, why are we doing a 50% tariff on Brazil, with whom we have a trade surplus? That's incoherent. But let's just benefit of the doubt here.
Okay.
If the goal is to get China,
let's do it like this. You're being like single-minded though. That's their single-minded objective, and they're playing a bunch of games all at the same time. So yes, do they have an overarching objective? Sure, but if I know you're a weak player, or if I get the sense that you have weak cards and that I'm strong and that I'm chip leader, and I throw on this big bet and I know you're just going to fold even though I've got shit, I can make that play, and I'm willing to bet the reason you lean into Brazil is because you know they're going to back down. You know you can be effective with this threat, and you might not think it doesn't serve this bigger overarching China play, which is probably true, but also sometimes you play the card, sometimes you play the player, and I think.
No, I understand.
The most likely outcome is that they're going to get what they want from Brazil. and they're going to move down the tariff rates. I don't think the most likely outcome is they get nothing from Brazil, and then they move the 50% tariff rate down to 10%. I think this thing is low likelihood.
Let me rephrase that. I think the incoherence would be if one of the goals is to re-domicile American manufacturing, which country has absorbed the most of it over the past 20 years? It's been China. So then implementing tariff policy that makes China more appealing as a destination to manufacture doesn't solve any of the litany of issues that they have stated for tariffs. If it's manufacturing jobs or fairness in trade or ring fencing China or decoupling for national security. Right? So like there's a whole things that it doesn't check by allowing Japanese tariff rates to rise above Chinese tariff rates. And right now they're not because it's 25%, but that's before all the other kickers go into play. So that's why I'm not taking August 1st seriously. I'm taking August 12th seriously as the deadline. And if the August 1st deadline goes into effect where Japan and South Korea have 25% tariffs and China only has 30, I actually think that increases the odds of Trump doing something negative with China, because you want ultimately, even if tariffs are going to be high in Japan and Korea, you want to have a gap between China and everyone else to disincentivize the building of new factories over there by American companies. So if August 1st comes and I'm wrong that it is something, August 12th is going to be big fireworks, in my view. So, I mean, I understand why volatility is bid for the second half of August. It makes complete sense. I would not fade that.
But there has to be, and I don't know what this number is, but there has to be some ceiling where above this number of tariff, then you actually have no comparative advantage with labor outside the U.S. And so I don't know what that number is. It's probably fairly high, and I don't know if adding a 30% tariff onto Chinese goods is going to, like, if that's enough to take away their comparative advantage on labor. I would imagine it's not. But I don't know. You get what I'm saying? Like at some point, the gamesmanship between China and Japan doesn't matter anymore because you've taken away the comparative advantage. It just makes more sense to build it in America. I don't know what that number is, but that has to be some ceiling to be considered or gamed out.
Yeah, but the way that you would work that out, you got to factor productivity. You have to factor wage differences.
Yep.
Obviously, the exchange rate for dollar yuan. I mean, there's a whole.
What do you think it is? If you had to just pick a number out of the thin air.
The prevailing wage rate in China right now is under $4 an hour. Okay.
Yep.
And I think what the average wage in America right now is closer to 25. So so 25 divided by 4 is a little bit over 6.
Mm-hmm.
So 600% tariffs. Just like as a starting point, as an estimate.
That's fair. All right.
But this is the whole thing with tariffs. After a certain point, right? It's not 600% isn't the number where people go, oh, I'm not going to buy from China, because there are substitutions. There are other countries that also make widgets. And so the reality is once you push tariff rates on China past, I think it's like 85%. I'll have to double check the research that we did here. But once you push past 85%, you've killed 95% of trade between the two countries. And so then you're just 85% tariff and 100% or 200% tariff rate. Trade's dead either way.
Would you be buying Chinese companies here? They're getting pretty cheap.
Depends what kind of company.
Okay, so let's do two different types. There's Chinese tech and there's Chinese consumption. So like JD.com, Pinduoduo would be the consumption side, and then Alibaba or Baidu would be the tech side, as a quick example.
If you're a really big believer in the efficacy of Trump's policies and trade, you probably are going to lean more in the direction of Chinese consumption stocks. If only because one of the problems that we, the United States, as our official communications have stipulated from the Trump administration, we feel that there is an imbalance in the Chinese economy where they overproduce, save too much, and they don't consume. And so rebalancing the trade relationship would mean that China consumes more domestically. They don't just sell us stuff, they buy more of our products. They also just don't sell their own stuff on the global markets. They consume more of it domestically here. So if you think that that Trump's going to get his way with all of this, right? And if you're a betting man and say like, oh, I think this is all really going to work out, your bet would be on Chinese consumption stocks. But if you think that this isn't going to work out in some form or fashion, and as my Uber driver said last week, because he was from Guangzhou and I was just talking with him about, because he was self-driving the entire drive over to the car dealership. Okay. He was telling me how, the Chinese economy is fine. People just don't want to spend money because they're worried about, America. And so like people have lots and lots and lots of savings there. So if the Chinese government opens the spigot for consumption, that's really going to be the cue. And that's dependent upon the trade war. But if not, how can you not bet? Didn't the Trump administration last week quietly, I think it was Thursday afternoon as everyone was driving off to their July 4th weekend, relax some of the restrictions on Chinese chips? One of the pieces of news that came out today is that China right now is trying to build one of these mega clusters, big data center for AI. And they're going to try to use Nvidia's new top-of-the-line chips because they think that they can get around all the various export restrictions thanks to their interpretation of last Thursday's Trump administration announcement. So you know what? Like right now, if the Trump administration is going to give Nvidia Blackwell chips to the Chinese government to build their own AI, and the trade war presses on, why wouldn't you want to bet on Chinese tech as opposed to Chinese consumption?
I think you would too. I really like it, and I think they're getting cheap on a relative basis to U.S. stocks and just in general. I think they're starting to get really attractive and nobody's talking about them, which means I like them even more. What do you think about, it seems like I'm going to switch topics a little bit. It seems like the administration is going to switch gears here from the big, beautiful bill to the Genius Act and to focusing on stable coins. I think this already passed one chamber. I'm not sure if it was the House or the Senate. I think it was the Senate. Now it has to go back to the House. Your thoughts on just Bitcoin in general up here, flirting with new all-time highs at 111. Your thoughts on Coinbase, which had a pretty decent move today, Circle, and just the stable coin space in general.
I don't think about Coinbase. I really like Bitcoin up here still.
You like it here?
Well, yeah, that's why I was buying a bunch of IBIT calls several weeks ago, Victor. I'm thrilled to see it doing what it's doing right now.
Same.
Because it makes sense. I mean, that chart setup, find me a chart setup that looks bullish like that. And I'll show you a chart that goes up. If it was the pullback in April, back down to the former swing highs that we had in 2023, okay, right near 74,000. And then this consolidation up towards 110K, where it gives you a flag or a pennant or a symmetrical triangle, pick your poison. This thing has a measure move up to 135,000 if you're looking at the continuous BTC futures contract. And for IBIT, that puts it in the neighborhood of the mid-70s. So I think this is great. I've been sitting on some IBIT call spreads, long 75, short 85. They were really cheap. And I hope that they become less cheap in the next few sessions because it looks like this thing is popping, ready to pop. But you know what the best part about this is, Vic?
What?
I keep bringing this up. I've been bringing this up for 2 months now. Where are the people in Miami sending us videos of them at 11, okay, spraying people with champagne? Where are them on the boats? Where's the Lamborghinis? This is so quiet. And I know that your whole view on this was, well, back in January, they were doing that to pump exit liquidity, basically. I want to get out. Let me show everyone my bag. They can have this bag too. I'll sell it to you. Here, come take the bag. This time around, people have delivered. So, I mean, if you look at Glassnode right now in the analytics and their liquidity chart, the liquidation levels chart, you can see that the highly levered people are basically wiped out if this thing goes below 107. But when you get below 107, the leverage drops off a cliff. It's a lot more long-term holders, and that rate where the whales are sitting is slowly rising over time. So I think this looks fantastic. It's ticker agnostic. Find me a better looking bullish chart than this right now in the market. And volatility is relatively cheap. So I'm playing for the upside here. Deficits, debts, Jeffrey Epstein. Why are we still talking about Jeffrey Epstein after all this time? Victor?
I couldn't believe he said that. Are you still talking about that guy? It's like, oh my God, I couldn't believe he said that.
Nothing made me have less faith in the U.S. dollar than that yesterday. So.
Are you still talking about that guy? How wild. I don't even if, let's just imagine. Okay, let's just imagine it's 20 years from now. It's one of, I mean, if you allow yourself to think through what that was, even if you assume there's no intelligence links, that will live on in infamy. We'll never stop talking about that. It's disgusting. It's insane that it was allowed to get to that level. And now you add on this other layer where it could have links to intelligence. It likely had links to intelligence. And like the president feigning like, were you still talking about that guy? It's like, what a bold attempt, what a bold attempt to hand wave the thing away.
So there's like two angles to this, right? There's the side of me that's like, okay, yeah. And like, yeah, it was an intelligence agency. Mossad killed Jeffrey Epstein. There's that angle. We can run with that. And that's fun. Okay. That's fun. And then it also reminds me of, there's that old JFK joke. A man dies and he goes to heaven and he gets to the pearly gates and he asks God, did the CIA kill JFK? And God says, no, I actually had Lee Harvey Oswald do it. And the man says, this thing runs deeper than I thought. So for some people, there's no amount of evidence, but the way in which this was delivered, like Pam Bondi saying things and like shifting and looking over at Trump to like make sure that he was reacting positively to every other word that came out of her mouth. So come on. If why was he in jail if there were no clients?
Yeah.
Who are the clients? Yeah. Who is? This is awful. It's awful.
It's a bit sad, it's a bit demoralizing, And I said this would happen.
You were moralized before this?
No, I feel like we're moving down this path where I said this administration is going to lead to one of two things. It's going to lead to a very angry constituency that no longer believes that they have the ability to vote change, the necessary change, and that's dangerous, or it's going to lead to just unbelievable apathy where people just give up, where they same thing. They recognize they can't vote their way out of change, but for whatever reason, they don't have the initiative to do anything about it or the anger or whatever it takes. And so they just become completely apathetic. And I'm not really sure which direction we're moving, but it's like, this is another drop in that bucket moving towards either apathy or anger. I think I'm super apathetic on this one, that like, that we just hand wave it away. Clearly there was something here to investigate, and we just move on. Say nothing to see here, folks.
Yeah, look, when the one big beautiful bill was struggling in Congress, what happened? We bombed Iran. Mm-hmm. And then all the attention went to Iran. And then I thought it was really very cool that the Democratic Party spent more time attacking Mamdani than the bill in the run-up to the bill being voted on. Yep. Like really important party priorities there. And then so now that this Epstein thing is happening, there's also that part of me, like, is the stock market complacent? Like everyone, as a future president said in 2012 or 2013, talking about then President Obama, one might start a war to distract from things. Mm-hmm. So wait, that was Trump who said that about bombing Iran. So.
Where was I going? I was just going to ask you something about related. All right, I'll keep cruising. I'll probably remember it here in just a second. I'll go metals for just a bit. It's to me, it's fascinating that the interesting trade here is no longer gold. And I thought when that happened, the transition would be like, okay, this is time for silver to shine, pun intended, but it wasn't. Platinum sort of had a lot of the attention, and now it's copper, and nobody gives a shit about gold or silver, and copper's at all-time highs, which was good for, I think, Freeport McMoran. How do you pronounce the last one? Freeport McMoran position. Your thoughts on metals, both precious and base here?
Well, the copper news, obviously, again, one of the illustrative examples of how tariffs, depending upon the product or good, will have a different impact. Because we are, we're not a big producer of copper. We have about an 800,000 ton deficit in terms of how much we consume relative to how much we produce. And so if you're going to bottleneck supply a bit more, then you're just going to raise domestic prices. And copper prices feed into everything, right? So that's maybe problematic. But I say maybe because, as we discussed earlier, only about a 0.05% increase over 2 years in CPI. So how problematic is that really? I digress. With copper, I think the problem that traders will have first and foremost, and I think the reason why you brought up FCX, is because copper was a freaking mess yesterday to trade. Good luck getting out. And that was something that I saw people, they were telling me about, saying like, oh yeah, I'm long. I want to get out of this position and realize my gains. Can't do it.
Good luck.
Right. And so that's why you're talking about FCX, because FCX is a little bit more liquid than copper futures. And the margin on copper futures absolutely blew out yesterday, where if you wanted to do like a short call spread, like a simple 10-cent wide short call spread, like the 565, 575, I think it was like 49 something days to expiration in that neighborhood, like $10,000. So no, thank you. Does it change anything? For gold and silver, look, we just had this big vol crush period over the past few weeks, and gold and silver did not pull back meaningfully. When gold IVRs were sitting north of 90 a few weeks ago in April, and we were at these current prices, if you told me gold vol was going to go back into the 10s or the 20s, like the teens, I would say, okay, well, how far is gold going to fall? And you told me that gold's not going to go anywhere, I would say, wow, that thing is still so bullish. Right? Like complete collapse in gold vol and prices don't move. So they're weathering a storm. They're weathering a storm of a dollar bounce and the higher yields over the past few days. I think you have to view that as positive long term. And have any of the influences, Victor Jones, have they changed whatsoever? Are central banks no longer buying? Are the concerns about the dollar's role in the world having changed meaningfully? No, not at all. Gold and silver look good. Hard assets look good still. We and I have been on this beat for the past year plus, talking about them on the show.
Agreed. Do you think, though, that over this last week, the slight reversal in the dollar fortune, do you think that can turn into something more meaningful? Like, are you still on the short? Are you still on the short dollar train, or are you fading this? And if so, which currencies are you playing a stronger dollar in relative?
Right. So my two areas of focus are going to be on the euro and the yen. Euro, I don't have anything in right now. It's watch listed. The yen, I do. A few weeks ago, within the last 2 weeks, when 6J rallied up into our James Bond level 007, I started laying out a position for the long 0068 puts and then 0068, 0067 put spreads, long them in the tastylive follow account. And so the idea there being that this is just a stretched trade. The yen doing well, so to speak, in April is really about the collapse in oil. But the reality is that Japanese long end yields are absolutely blowing out right now. And the yen long position in this market is still so saturated. I like to use a Z-score, basically measuring how far something is away from the mean, standard deviation. So a Z-score of 1 would be one standard deviation away from the mean. I like to look back over the past 2 decades in the CFTC COT report. It's weekly data, 52 weeks a year, times 20 years, over 1,000 data points. Okay, it's a robust data series. The Z-score right now for yen positioning is 2.66. The only other times that we saw it higher in history were actually a few weeks ago when we top ticked 3 on the Z-score, and that was in April. And then what happened in April thereafter? The yen stopped rallying and it was just too crowded of a position. So forget Japanese domestic issues with inflation and rates. If there is going to be a dollar reversion, this seems like really fertile ground for it. And to that end, the other currency that has a Z-score north of 1 right now is the euro with a 1.34. And between the euro, 57.6% of the dollar index, and the yen, which is 13.1, you're talking about 70% of DXY north of there. And so if those two things are the most crowded long dollar or short dollar positions right now, and they bounce back because people simply take profit, right? I've been long the euro all year long, for example. I want to take some profit, realize this trade, I'm going to have to close my long, even if it's just a profit-taking move. A rubber band snapping back tactically, to me, makes some sense. So I'm long the dollar via the yen. I will say one thing about this, though, to add on to this. Positioning is not a typical Tasty trade. Somewhat perhaps instructively, last year, all year long, first half of the year, the yen is going to rally. Look at the short position in this market. It's never been this short before. It's going to rally. And January and February and March and April and May and June, what did I do? I got long the yen. And every single month I took a small loss. And then come July 1st, I said, you know what? I'm not going to put this trade back on. And then what happened to 6J in the month of July and August? And so like here's why that matters. Was the rationale, the reason why I was putting on that position at the start of every month, was it still valid come July 1st? And the answer is yes. I just tapped out and decided to leave my mechanics. It was right, but it took a long time. The market stayed irrational longer than I was able to stay solvent with that position. And so this is another one of those scenarios. I'm not making that same mistake again. So with these large positions, I'm keeping these in my back pocket. It's not a typical Tasty trade. It's the dollar positioning is cooked. We have a tactical bounce opportunity. I'm going to push on that string in a high convexity way, so that if I'm wrong, I can be wrong 12 months in a row and not feel the need to tap out. And when I get my one winner, it's going to make up for all of it.
So you're long dollars.
Started scaling in a week ago through the yen, yeah.
And you're long bonds, basically your long notes, right?
Long bonds, neutral notes.
What are you what is it, iron condors and notes? I forgot.
Short iron condor and notes. Okay. Long 115, 117 call spreads and ZB.
So what does a world look like where the dollar's rallying and the long end's rallying as well? What kind of president would you get in that world?
President Camacho from Idiocracy.
He'd be pretty emboldened, don't you think?
Oh yeah.
That's the hard part about taking these bets, is that I think you would have to fight against a crazy person who would be emboldened to get more and more sort of.
Victor, he threatened to bomb Moscow today. You don't think he's emboldened already?
Did he threaten? You're talking about the leaked tape where he's talking about Moscow and China? Did he explicitly do it?
No, he was asked this in the news gaggle
today. What did he say? I didn't see it.
He was like, yeah, I'm not happy with how Putin's treating Ukraine.
And then what?
He was asked if he threatened to bomb Moscow in a phone call with Putin, and he acknowledged it. and he's like, yeah, Putin was like, no way you wouldn't. He was like, way.
No, he wouldn't.
No, of course. I mean, who am I to say what's going on in Donald Trump's head? To say that he wouldn't bomb Moscow?
I hope zero chance.
I don't know. There could be Victor. There's rumors of P tapes. Maybe they find.
If there was a poly market on that, I'd sell it until my hands bleed.
Yeah, because that's the World War III scenario. There's no country that's dropping a bomb on Moscow and not receiving a nuke from Putin on the other end, if it's Germany or the US or Canada or whoever.
Plus, it's just not how. It's not. I don't think. Yeah, you would have to do a targeted strike, and you have to make sure you get Putin, and you'd have to have this succession plan already made up, and those people somehow couldn't have leaked. It can't have been leaked inside of Russia, which is nearly impossible. It's never going to happen. Never.
You'd have to leak plans that it's Dmitry Medvedev. That's the one who's getting ready to succeed Putin. So you start discord within the regime. Not that I gave this out.
Who do you think is going to be the next Fed chair? Hassett's sort of taken the lead lately.
Okay, so
I don't think it's going to be traditional. I think he's going to pick Besson or Hassett. I think he wants somebody who he can quote unquote trust, and I think all of his advisors are going to try to lean him into like a Warsh or something like that. I don't think he's going to go that direction. I think he's going to pick Besson or Walt or Hassett. I've always felt that way. I think it's likely Hassett, Because
it's the best case scenario for the market.
Do you think so?
Yes.
What do you mean?
Not that I think that Kevin Hassett's a particularly sharp tool in the shed, but he checks the boxes where he's been consistent in his economic orthodoxy or unorthodoxy, depending upon where you sit, for a number of years now. He also was in Trump term 1.0. He's now back for Trump 2.0. He's a guy that has had very little controversy around him as a public policy official, unlike Stephen Miller, for example, right? MSNBC is not going after Kevin Hassett the way they go after a Stephen Miller. Okay?
Not yet. They will.
No, but
they're using this guy. What's his name? Justin Wolf or Wolfers or something like that. These University of Michigan
economist.
guy.
Justin Wolfers, the Australian economist.
Yes, he's very clever what he's doing because he sees an opening. Most economists play things down the middle, and he saw an opening to be like an MSNBC style economist, and so now MSNBC and CNN have him on a lot. And
he's been on Bloomberg since I was coming out of college. Like this guy's been on the media forever. He's been around forever. He's
not anymore. He's not on any of those channels anymore. Now he's on all the cable news channels.
Yeah. Well, I think Hassett's the best pick because he checks the loyalty boxes for Trump, but in his own discussions of economics, he doesn't come across like a toady. He doesn't come across like
he is. But he is. That's why Trump can pick him. Because it's like basically Trump's going to be Fed chairman, effectively.
Because Bessent is someone who I think, as market observers, given his reputation versus how he's carried himself as Treasury Secretary, I think, and like Lutnick too, I think a few of us are like, these guys didn't seem like these people when they were in the private sector. They weren't this colorful. They weren't this opinionated about things. And so, like, is this really who they are? Is this just a show they're putting on to please the boss?
Lutnick is a show, 100%. Do you think Bessent's been a good Treasury Secretary?
I don't think we have enough. I don't think 5 or 6 months is enough time for a Treasury Secretary to make a really big impact. I'm not super impressed by his communication style, but he has also made any really big mistakes. And like, one of the things that I want out of my Treasury Secretary is to not really think about them. Like when you think about like who are our best Treasury Secretaries been, it's all people who have been forged in crises, right? You want a boring Treasury Secretary is what I'm saying. So he had a steady hand on the wheel in April, right? So I suppose he survived his first test. The bond market didn't go off the wheels. We haven't seen any failed auctions. What more can you ask for?
I think he's been pretty good.
Yeah, I mean,
I had no opinion on him coming in. And
isn't it asymmetric though? Like you can either be like you're either going to be a very bad Treasury Secretary, or it's like, oh, they did it, they did a good job.
I don't know. I think. How do you feel about Yellen?
Mixed.
Exactly. So it's not binary,
Yeah, but like I take the same issue of fiscal dominance. Yellen, people criticize, oh, you're issuing all this short-term debt. You're allowing the federal government to crowd out the long end of the curve. You got to just issue the debt the way that you're supposed to issue the debt and not tinker with the issuance schedule so as to please Biden. And like Bessent's doing that now again too. So like the same critique that one might have of Yellen, one may have towards Bessent at this point.
No, my biggest thing with her is she just didn't term out the debt. Like she had an opportunity to term out debt when almost every other corporation did it, and it wasn't like it wouldn't have. You don't have to have an IQ over 90 to think about that and to do it, and she just didn't do it, and would never get that opportunity again.
Yeah, and I think that's the plan here. Hopefully, we can term it out again. We didn't do it in the 2010s. We didn't do it post-COVID. But anyway, the point is, Lutnick and Bessent look like they've changed something about themselves, and they come across as a little like suck-uppy. Whereas Hassett doesn't. Hassett looks like he's just been a run-of-the-mill Republican economist for decades. Trump latched onto him. He toes the party line. He's been consistent enough in how he portrays himself and his views on the world that were he to join the FOMC, and I think this is the dynamic, the Fed chair doesn't set policy, even if Powell has been able to unify the board very clearly here. They're one of a number of people on it. And I have just this feeling, given everything I've read about how the Fed operates, the memoirs from different Fed chairs, the interviews, if you get a Trump toady in there, the rest of the FOMC is going to get defensive, and they're not going to take that person seriously, and they're not going to go in line with them. But if you get someone like Hassett, who there is mutual professional respect because they've been doing this for a number of years, and they don't just flip-flop. They don't do that. They're not the John Kerrys of monetary policy, as Neil Dutta at Renaissance Macro pointed out today. Right? Like that's important for the market. And so Trump can have his way. He can get the guy that he wants in there and have someone who has enough of a track record without looking like a suck-up. And that's Kevin Hassett.
Do you think the board will respect Hassett to that extent?
They'll respect him more than they would respect a Lutnick or a Besant or a Warsh, who all of a sudden it looks like he's trying out for a job.
Yeah, he really does. It's
sad.
Almost like watching Gavin Newsom of the monetary policy world.
That's a really good comparison. We just need him to start a podcast.
All right, man. If people want more from you, and they should, tell them where they can go.
You're on Tasty Live Monday through Friday, Futures Power Hour, 1 p.m. Eastern. Let me explain. Tuesday mornings, 9:40 a.m. Eastern. The Price of Truth, Wednesday, 6 p.m. Eastern, and then overtime with Radigan and Spivak, Monday through Thursday, 4 p.m. Eastern.
How long until these guys in the chat are saying this? I'm curious. How long until we have an AI bot as the Fed chair?
Well, do we think that Grok is going to be the next CEO of Twitter? I think that's the first step in the direction. But an AI, isn't that just the Taylor rule? Isn't AI just going to execute monetary policy in an algorithmic fashion then?
Maybe, but I don't know. I suppose there is room, if you imagine that the AI has reasoning capabilities, that there is some subjectivity there.
Mecha Volker.
I'm not touching it. All right, everybody. Hit the like button on your way out. Subscribe to the channel if you haven't already. Make sure you follow this man on Twitter. You can follow me on Twitter as well, at Victor Jones. Owen Jones is 0 because I like to be difficult. Special thank you to you, Christopher, for coming and hanging out for 60 minutes. For all of you, I will see you back here tomorrow. Same time, same place, same great network, only on Tasty Live. Till then, peace. Build.